Namaste. Good morning. We continue with wherever we left in the last class. We did perquisites to a larger extent in the last class. Okay. The various taxable perquisite and how it is computed. The value of perquisite being computed. We saw in the last class. And the most important perquisites are this rent-free accommodation, transfer of asset. Okay. We also saw car as a perquisite, interest-free or concessional interest loans. Okay. We move on to see beyond perquisites, whatever is taxable or not. There are some perquisites which are never taxable, which includes telephone, mobile and internet bill, personal accident policy and group insurance policy. So, in the question, if they have given medical premium paid for the employee, friends, once more repeating, if in the question they have given medical insurance premium paid for the employee, we should assume it as group insurance policy. It is not for that particular employee they are paying for all the employees. So we should assume it as group insurance policy only and not tax it. There can be words like personal accident premium policy premium paid, which is also exempt. Even it can be for a singular employee. All the sales people, all people who travel a lot will be paid this. It can even be, that is again for official purposes only it is paid. So it is exempt. Okay. Repeating. If life insurance premium of employee is paid by employer, taxable in the hands of the employee, because that has nothing to do with the official part of it. Whereas medical insurance and life insurance, group insurance policies are getting the exemption or not taxable. Training expenses, refreshments are never taxable except lunch facility, which is 50 rupees per working day. Otherwise, refreshments are not taxable. Am I clear to you? Okay. Moving on further, we know about the types of provident fund. There are 4 types of provident fund. Friends. Provident fund is having 4 aspects: SPF, RPF, URPF and PPF. This PPF has nothing to do with employer. This PPF has nothing to do with employer. It is public provident fund where any person, not necessarily employee, any individual can go and contribute. This will come under 80C. This deduction can be claimed under 80C provided assessee is in the optional tax regime. In the default tax regime, you cannot claim it. So let's leave PPF for a minute. When we are doing the total income, we will see PPF. The other 3 are statutory provident fund, which is basically for government employees. Remember, whatever you receive is fully exempt. Whatever paid is fully exempt. In all these cases, I have been clear in the last class itself. Employee's contribution. You need not worry about it while computing salary. It is always part of basic salary. If I say basic salary is 40,000, I don't get 40,000 in my hand. They will deduct PF, they will deduct TDS and only give me the balance. But what is taxable is 40,000 into 12, 4,80,000. So never worry about employees' contribution. That will be coming under 80C again. Employer, interest on employer, lump sum, everything is exempt in the case of statutory provident fund. In the case of statutory provident fund, which is basically for government employees. Coming to RPF, this is an approved fund, and here there is a restriction. Employer contribution restricted to 12% of salary. If employer is going to contribute more than 12%, that will be taxable. And salary has the same meaning like HRA, basic pay plus DA forming part plus commission as a fixed percentage of turnover. So salary has the same meaning like our HRA. So employer contribution more than 12% taxable. If employer is going to contribute 15%, tax 3%. And the interest credited, okay, more than 9.5% is going to be taxable. Interest is not on salary. Interest is on the deposited amount. You need not worry about the deposited amount calculation and all. They will give you, if the PF department has credited interest at the rate of 12%, 1,000 rupees, for example. So if 12% is 1,000 rupees, what is 9.5% or what is 2.5%? The excess, and tax that excess. 9.5 is exempt, 2.5 becomes taxable. And lump sum is normally exempt if the employee completes 5 years of continuous service. If the employee completes 5 years of continuous service, the lump sum received is exempt. Okay, I am nowhere, we are again going to see in one of the class this, but I'm just putting it into your mind. The TDS for that is 192A, where the PF department is liable to deduct tax. Because how will the income tax department know the employee completes 5 years or not? Income tax department will not have the records. So they make the PF department responsible. They make the PF department responsible, asking the PF department to deduct tax if the employee has not completed 5 years of continuous. Because PF will immediately look into whether there is 60 months of remittance. So they have all the records. So that's why the deduction is by the PF department. We will see the deduction later, but I am putting it into your, sometimes if you put all these things, you can easily understand conceptually. Okay, so this is with regard to RPF. If the employer completes more than 5 years, don't even worry what is the amount, etc. The whole of the amount is exempt. Unrecognized, that which is not approved. That which is not approved. Here again, at the time of lump sum only, everything is going to be taxable. At the time of receiving the lump sum only, everything is going to be taxable. What is lump sum? Lump sum consists of 4 things. Employee contribution. Okay, remember, not taxable because you have already taxed it. I told you 40,000 paid, 40,000 is taxable. So the entire 40,000 becomes taxable. So you have already taxed it. You will not be taxing it. Okay, employer contribution, taxable. You will tax it. Whatever is the contribution, you will tax it. Interest on employer contribution, taxable as salary because the word employer is appearing, whereas interest on employee contribution is taxable under IFOS. There is a small change. It is also taxable, but head changes because there is no employer employee relationship between the payer and the receiver. Once more repeating on the URPF part. Okay, on the URPF part, lump sum received, employees contribution not taxable. Employer's contribution plus interest on employer contribution is taxable as salary, whereas interest on employees contribution is taxable as IFOS.
Excuse me, sir.
Listening, friend, go ahead with your question.
Sir, in the case of RPF, interest on employer's contribution also taxable under salary as well.
Yes, Raja. In the case of RPF, there is no division of employer's contribution interest, employees' contribution interest. Exempt up to 9.5% and balance. It is always on the deposited sum. It can be, you need not split it between employer and employee.
Okay, sir. Thank you.
Am I clear to you? Okay. SPF, RPF, SPF, don't worry. RPF, PPF, okay, there is something to catch it up. Am I clear to you? Okay, let's progress. Okay, before progressing, let me answer some things which from the last class, the feedbacks which I got. I want to answer something. Okay, there are a couple of our friends who felt that I am very slow. Okay, and there are a few who felt okay speed. Sometimes I go little fast. Please stop me. Otherwise, if I am slow, please be happy. Very rarely I am very slow. Okay, that is one thing. Second, is the number of questions sufficient? That's what they said. I assure you that number of questions we are working is sufficient. It is the same Chinese proverb that I am using here also in tax law, that I am not giving you a fish, I am teaching you to fish, so that you will be more clear about how to work out a question. At the same time, individual chapter, if we are working 4 or 5 questions, we are again going to work out total income. At that time, we will consolidate. So the number of questions are sufficient. Stay on, conceptually understand everything. I will ensure when we work out total question, your confidence level increases. Having said that, PGBP, I have the next class. That is on, I think on 14th is my next class. On 14th, I have exclusively marked for PGBP. That day, I will not do anything else. And that day, I will work out sufficient questions in PGPP also for you to get the confidence. Both conceptual clarity, all said and done, questions are coming from few areas only. In this examination oriented approach, those are our concentrating areas. So be sure that those areas will be covered. Let me go to the next one, that is pension fund. Pension fund. So again, like provident fund, there is something known as national pension scheme, national pension fund, for which contribution is made both by employee and by employer. Remember, both are added to gross salary. Obviously, employees, that 40,000 principle, you remember. My basic pay is 40,000. They will not pay me 40,000. They might even pay me 30,000, 4,000 for PF, 4,000 for TDS, 2,000 for pension. They will deduct and pay me 30. But what is taxable is 40,000 into 12. So, even employer's contribution is added to gross salary. Even employer's contribution is added to gross salary. That is the difference. The employer's contribution to pension fund, not provident fund, pension fund. Provident fund, more than 12%, it becomes taxable. But here, it is added to gross salary, where in a later section, I will get the deduction. Where in a later section, 80 CCD subsection 2, I will get that deduction. Once more repeating, it is initially added to the gross salary. Later, deduction is provided under section 80 CCD subsection 2. Employer's contribution. And the most interesting is, even under the concessional tax regime, I can claim this. Even under the concessional tax regime, though I'm going to discuss on deductions later, but I'm just throwing some ideas now itself. Even under concessional tax regime, I can get it. So it is like nullifying effect. Add it as gross salary, provide it as deduction. Add it at the top, reduce it at the bottom. To the extent of 14% of salary, which we will see it later. To the extent of 14% of salary, it is allowed as deduction. So, pension fund is slightly different from provident fund. In pension fund, okay, even the employer's contribution will first be included in the gross salary. Later, I will provide the deduction. Later, I will provide the deduction. Am I clear to you? Am I clear to you? This is with regard to perquisites and pension fund, provident fund, etc. I move on to an area called terminal benefit. I move on to an area of terminal benefit. There are 5 terminal benefits. Gratuity, commuted pension, or we'll call pension. We'll do both commuted, non-commuted. Leave encashment, voluntary retirement scheme compensation, VRS compensation, retrenchment compensation. The last two are not of examination importance. The last two, 5 lakhs is the exemption. You can be sure of. The amount paid will be very high. 5 lakh is the exemption. One time you can claim it. So that is of least importance from the examination perspective of it. That leads us to 3 things: gratuity, commuted and uncommuted pensions, leave encashment. Uncommuted pension is nothing but salary. Uncommuted pension is nothing but salaries, basic salary like that, which is received monthly by me. Slowly, uncommuted pension is received monthly by me, which is fully taxable. Every month I get 10,000 as pension. For 7 months last year I got, because first 5 months I was in employment, and 7 months, 7 into 10,000, 70,000, fully taxable, whoever you are. whoever you are, fully taxable. Why I use whoever you are, you will understand very soon. Otherwise, gratuity, commuted pension, leave encashment, if it is government employee, fully exempt. That's why I said whoever you are. Gratuity, commuted pension, leave encashment. If you are a government employee, nothing is taxable. Nothing is taxable. Whereas uncommuted pension, even for a government employee, you get it taxed. You get it taxed. Is the class clear? Okay. Now let us come to a non-government employee, how this is getting treated. How this is getting treated. First, let me speak about gratuity. In the case of a non-government employee, I have only two things to see. Whether he is covered under Payment of Gratuity Act or not covered under Payment of Gratuity Act. Okay. Whether the employee is covered or not covered, if the question is silent, which is not possible. In exam, they are very clear. But suppose if the question is silent, not covered. Not covered. But in exam, they are very clear whether they are covered or not. How to compute? The exemption is there in section 10, subsection 10. Okay, take your time. Slowly we will understand. What is the exemption? Actual received, same. $20 lakhs, same. The second condition here is 15/26. 15/26. 4 Sundays are excluded. A month consists of 30 days. 4 Sundays are excluded. Into last month salary into completed years rounded off. The law says up to 6 months round off to the lower extent, more than 6 months round off to the higher extent. Somebody completes 20 years and 5 months, 20 years. 20 years and 7 months, 21. More 20 years and 6 months, 20 only. Up to 6 months. The exact words of the law is 15 days salary for every completed year or part thereof in excess of 6 months. This is the law words, which means if it is more than 6 months, round off to the higher level. Less than 6 months, round off to the lower level. Here, the second condition is 15/30 into average salary into completed year of services only. Even if it is 20 years, 11 months, 29 days, 20 only. 20 only. Only completed year of service. Okay. So 15/26, 15/30. Last month's salary, average salary. Here round off is possible. Here round off is not possible. Now that leads us to understand what is salary. Here salary is basic pay plus full DA. Here basic pay plus DA forming part plus commission as a fixed percentage of turnover. So the next difference is majority of the time POGA, Payment of Gratuity Act, falls under one of the Industrial or Factories Act. So it is applicable for blue collared employees. Whereas not covered under POGA is for a white-collared employee. I want to benefit the blue-collared employee, so I take whether forming part or not full DA. Whereas when it comes to not covered under POGA, I only take DA forming part plus commission as a fixed percentage of turnover. Am I clear to you? And what do I mean by this average salary? Last 10 months average. Last 10 months means if you retire on the last day of the month, take that month also. If you are retiring in the middle of the month, go back the 10 months, leaving that particular month. Repeating the gratuity provisions, okay, in our material, in our concept book, okay, actual 15 by 26 into last round, maximum basic plus full DA. 15 by 30 into completed year of service. Average means last 10 months preceding the month of employment. If employee retires during the month, then leave that month and we need to go back 10 months. If the employee is leaving on the last day of the month, then include that month also. Include that month also. Salary is equal to basic pay plus DA forming part plus commission as a fixed percentage of turnover. So, in both the cases, whichever is less is exempt. The balance becomes taxable. The balance becomes taxable. Am I clear to you? Am I clear? Okay, right? Online friends, are you following?
Yes, sir.
Yes, sir. Yes, sir.
Thank you. Commuted pension. What do I mean by the word commuted? Commuted is nothing but compute, lump sum. Commuted means computed. Every employee has the right to get 100% of his pension commuted. Depends upon the policy, etc. But 100% of the pension can be commuted. So instead of receiving pension every month, I try to receive the pension as one lump sum. But I also have the hybrid option. A part of the pension I will commute, other part of the pension I will receive on a monthly basis, on a regular basis. Once more repeating, commutation need not be 100%, though eligibility is 100%. So what does the law, income tax law does not worry about what you commute under. Income tax law, what is exempt, what is taxable. So I framed rule under section, provisions under section 10 subsection 10 AA to provide like this. To provide like this. Receiving gratuity, not receiving gratuity. Like this, I split. Receiving gratuity, not receiving gratuity. If I am receiving gratuity, 1/3 of 100% is exempt. 1/3 of eligibility, not what is actually commuted. Please understand. Please understand, 1/3 of what I am eligible to. If I am not in receipt of gratuity, half of what I am eligible to. Eligibility is always 100%. Eligibility is always 100%. My dear friends, okay, if I am receiving gratuity, 1/3, not receiving half, okay, eligibility is always 100%. So in a question, how this will come? In a question, how this will come? The question can be like this. 60% of the pension is commuted and the employee received 1 lakh. I'm just giving you an example. So if 1 lakh is 60%, what is 100%? What is 100%? On that 1/3 or 1/2, depending upon gratuity received or not received, is exempt. Repeating, in the question it will be clear what percentage I have commuted, how much I have received. You need to rework to find out what is that 100% eligibility on that 1/3 or 1/2. On that 1/3 or 1/2. Now I take your attention to the important provision. Please understand this uncommuted pension. As I told, from 1st October, I am eligible to get 10,000 per month. Other things being constant, 10,000 into 6 months, 60,000, fully taxable. Whoever you are, government, non-government, whatever it is fully taxable. But what I do is, the other things are not constant. 60% I commuted on 1st January. 60% I commuted on 1st January. Now, technically, my uncommuted pension will be October, I will get 10,000. November, I will get 10,000. December, I will get 10,000. Jan, I will only get 4,000. That is nothing but 40% of 10,000. Because 60% I have commuted. So, Jan, Feb, March, I will get only 4,000. So, my taxable value will only be 42,000, fully taxable. Okay. So, uncommuted pension, you should see what is commuted, on which day it is commuted, and after that it reduces to that extent. If I have commuted 60%, remaining 40%. If I have commuted 70%, remaining 30%. Like that it goes on. It goes on. Okay. Please remember, uncommuted pension received periodically and it is fully taxable, and it depends upon the component aspect of it. Am I clear to you? Am I clear to you? Right? The last thing I want to talk about is leave encashment. Leave encashment. Friends, take a time and understand this. Every leave encashment is not a terminal benefit. I should check. What should I check? Friends, some leave encashments are paid every year. Today, many companies follow this. Why should I accumulate? This year, you are eligible for 40 days. You have availed only 20 days. The remaining 20 days here. Fully taxable. Fully taxable. If periodically it is settled, which can be yearly, bi-yearly, okay, once in 5 years, fully taxable. When will exemption come? Only if it is a terminal benefit. That is, you are accumulating and settling it. At the time of leaving employment, this exemption of 10AA comes. This exemption of section 10, subsection 10AA comes. Otherwise, it is fully taxable. Friends, here also, actual received 10 into average salary have the same meaning. Unavailed period recomputed on the basis of taking 30 days. So ignore your company's policy. Income tax law says, boss, you are eligible for 30 days of leave every year. How much you have availed? If you reduce it, unavailed into average salary, 25 lakhs, and the salary definition is the same, like house property, etc. Okay. Leave encashment. Read it once or twice in the question. Read it once or twice in the question. Whether it is paid periodically, never worry. Only if it is coming along with gratuity, with pension, then only understand it is a terminal benefit and provide this particular relief. Friends, don't worry about retrenchment compensation, VRS compensation. In both the cases, it is 5 lakhs. That will only be lesser. Okay, that is very, very, very rare. Don't worry about that. Profit in lieu of salary, anything other than allowance, perquisite, terminal benefits, fully taxable. And then coming to the final part of deduction, you are all very much aware of it. Standard deduction is 50,000 or 75,000. 50,000 if under optional tax regime and 75,000 under concessional tax regime. Entertainment allowance only for government employees. Again, these two things you cannot claim if you are an employee falling under concessional tax regime. Entertainment allowance is 20% of basic pay, 5,000 per annum. And professional tax, if the professional tax is paid by the employee, fully allow it. That is, it is recovered. If employer pays it, then nil effect. Add it to the gross salary, reduce it. Okay, and these are not allowed under concessional tax regime. Okay, the final notes will tell you what is salary and what is not allowed and allowed. I request you to go through the terminal benefit before going into a question to solve it. It is there in page number 20 to 23 of our concept book. Quickly read through. Quickly read through. We will work out and see. Shall I? Shall I? You can just see the screen also. I don't mind. I am going to start from page number 25, question number 3. Page number 25 up to question number 2. I have given the answer also. I will provide you the solution book also. But in the classroom, work along. Work, please, in the classroom, work out. I will provide you the solution also. You will, and this is more than sufficient for you for the examination. I will provide the solution, but not in the classroom. In the classroom, work out along with me. I am leading you to question number 3, page number 25. For some time, we will read the question once, twice, thrice, then go. Mrs. Radhika retired from employment on 16th December 25 after serving for 32 years and 7 months. At the time of her retirement, she was drawing a basic salary of 47,000. Her last increment was from August 5,000. DA 50% of basic pay, and out of which 50% forms part. Bonus 1 month basic pay plus DA forming part of October. Motor car of 1500cc owned by the company was provided to her from 1st April to 30th November. Expenses were met by the company, official as well as personal. On retirement, company provided her furniture and electric two-wheeler. Furniture was purchased in August and two-wheeler in September 23. Furniture was transferred free of cost, whereas the two-wheeler for 75,000. Gratuity received 12 lakhs. Employee is not covered under POGA. Radhika is eligible for a pension of 15,000 from 1st of January. On 1st of March, she commuted 60% of pension and received 6 lakhs. She received leave encashment of 4 lakhs for unavailed period of 220 days. The company's policy is 35 days leave for every completed year. RPF encashment fully exempt, my dear friends. She has completed more than 5 years. Computer a salary assuming she is paying tax under concessional tax regime and propose to continue so. Also compute salary if assessee is covered under Payment of Gratuity Act. Friends, HRA exemption, educational allowance, hostel allowance, all these things I accept. There will be a change between the concessional regime and the optional regime. Terminal benefits, you can claim the exemption under the both. Terminal benefit exemptions, you can claim under both. So don't worry about whether only that standard deduction will vary. Okay. Now again, I am from the top, I am reading. Radhika retired on 16th December. So, not covered under POGA. What I have to do is, I have to go back 10 months, leaving December. Once more. If I am retiring on 31st December, include December also. Since I am retiring during the part of the month, my past 10 months are November, October, September, August, July, June, May, April, March, Feb. This is my past 10 months to find out my average salary. Out of that, August, September, October, November, my salary is different. First 6 months, my salary is, basic pay is different. Okay, so that bonus, motor car, this transfer of asset, 10% SLM. Remember both the cases, 10% SLM. Computer and electronic equipments, 50% diminishing balance method. Motor car, 20% diminishing balance method. All other assets, 10% straight line method. Even if it is two-wheeler, it is not motor car, it is two-wheeler. Gratuity, pension, leave encashment, RPF. Friends, leave almost 10 lines and come to working note number 1, gratuity. Leave 10 lines and come to working note number 1, gratuity. All of us are working along with me. All of us are working along with me. Computation of taxable gratuity. Computation of taxable gratuity. Particulars, inner column amount, outer column amount. First, I will find out salaries. First, I will find out salaries. Salary of last 10 months. Last 10 completed months. Salary of last 10 completed months. Under that, from Feb to July. From Feb to July, 42,000 into 6. From Feb to July, 42,000 into 6. In the inner column, write the amount. 42,000 into 6. From August to November, 47,000 into 4. You will get the total of basic salary. How much is that? 4,40,000. The total, that is 42,000 into 6 plus 47,000 into 4. You will get 4,40,000. DA forming part. 4,40,000 into 50% into 50%. 4,40,000 into 50% is DA, into 50% is forming part. 1,10,000. Total 10 months salary 55,000, 5,50,000. Total 10 months salary 5,50,000. Average salary 55,000. Average salary 550 divided by 10, 55,000. Online friends, are you following?
Yes, sir.
Yeah. 55,000. 55,000. Is the class clear? Is the class clear? Anybody not understanding? Anybody not understanding? Shall I move on? Okay. Gratuity received. Outer column 12 lakhs. Gratuity received. Outer column 12 lakhs. Less exempt. Less exempt. Under that, actual received inner column 12 lakhs. Actual received inner column 12 lakhs. Actual received inner column 12 lakhs. Next condition, 15 by 30 into 55,000 into 32. Not covered under POGA into 32. Friends, repeating, 15 by 30 into 55,000 into completed years of service, 32. 880 and maximum limit 20 lakhs. Whichever is less goes to the outer column as exempt. The balance becomes taxable. The answer is there in your screen also. May I? All of us? Working note number 2. Commuted pension. commuted pension. Okay. Under that, commuted pension received 6 lakhs. Commuted pension received 6 lakhs. Less exempt. Friends, listen. Friends, listen. He has commuted 60%. So if 60% is 6 lakhs, 100% is equal to what? Into 1 by 3. Because we all know he is receiving gratuity. Just now we worked. So 6 lakhs divided by 60 into 100 into 1 by 3. 6 lakhs divided by 60 into 100 into 1 by 3. I think 3,33,333, and the balance becomes taxable. The answer in the screen. Working note number 3. Leave encashment. Let me be little slow. Be patient in understanding. The unavailed period of leave is 220 days as per company records. As per company records. So he has worked for 32 years. He would be eligible for 35 days every year. Comes to 1120 days he can take leave. But he has not taken for 220 days, which means availed is 900. Repeating. As per the company's policy, he is eligible for 1120 days. He has not availed 220, which means he is availing 900. But that is never our worry. I want to know, according to income tax law, how much is unavailed. For that, I need to rework. Income tax law says, boss, you are only eligible for 30 days. 960 days. And you have availed 900 days. So under our law, only 2 months unavailed. Only 2 months unavailed. Repeating, my dear friends. Repeating, my dear friends. Eligibility as per company's policy is 1120. Unavailed is 220. So he has availed 900 days. I don't require this. As per income tax law, you can eligible 900, 960. You have availed 900. So 60 is unavailed. First part, write down this. Finally, we'll convert it into months. Suppose if it has come to 55 days, you cannot convert it into month. So, if at all, finally you convert it into month. Otherwise, days is the correct working. Is it clear? Is it clear, friends? Am I clear to you? Okay. So once you know it is only 2 months, don't go and work out all the 4 conditions. Waste of time. Waste of time. Because second condition 10 months. Fourth condition 25 lakhs. Just to do the 2 months computation of 55,000 into 2, you will get the answer. Once you get to, if you get 14 months, 15 months, then only you to do all the 4 conditions. Otherwise, it becomes very, very simpler. The third condition will be lower. Shall I move on? May I move on? Now listen. Now listening sharp. I am going to do the next working note for the transfer of these assets. His date of retirement is December. This was purchased in August 22, August 23, August 24, August 25. For every completed year, you should provide. Not for the, in income tax law, no proportionate depreciation, not only here, anywhere. So for 3 years at 10% SL. This is for 2 years. He has purchased it in September 23, September 24, September 25, 2 years. And for this, he is recovering some 75,000, whereas for the other one, he is not recovering. So, working note number 4, furniture, purchase value in August 22, purchase value in August 22, 1 lakh. Less depreciation at 10% for 3 years. Less depreciation at 10% for 3 years. 30,000. Perquisite value 70,000. Because it is transferred free of cost, perquisite value 70,000. Two-wheeler, purchase price in September 23, 1,80,000. Purchase price in September 23, 1,80,000. Depreciation at 10% for 2 years, 36,000. Okay. Transfer value 144, less amount recovered 75, so 69. In your screen you can see totally you will get 1,39,000. 70 plus 69, 1,39,000. Are you clear? Are you clear? I'll do one more working note before coming here. Working note for gratuity covered under POGA. The question has also asked us to compute if the employee is covered under POGA. Computation of gratuity covered under POGA. Here, my dear friends, it becomes simpler. Gratuity received, outer column 12 lakhs. Gratuity received, outer column 12 lakhs. Less exempt. Just do the second condition alone. 15 by 26 into open bracket, my dear friends, basic pay plus full DA of last month, 47,000 plus 50% of 47,000. 47,000 basic pay last month plus 50%. So 23,500. Okay. Close bracket into 33 completed years of service. Completed years of service. My dear friends, repeating, salary of November plus full DA, and it is 33 completed years of service rounded off. Rounded off, so that I'll get nil as the answer. The amount received is lesser, so nil. Computation of salary in the main answer, in the space you have left in the first. Computation of taxable salary. Computation of taxable salary. Friends, basic pay. April, May, June, July. 42,000 into 4 in the amount in the inner column. 42,000 into 4 amount in the inner column. 42,000 into 4. Okay. Okay. August, September, October, November plus 15 days. 4.5. He is retiring on December 16th. 47,000 into 4.5. 47,000 into 4.5. 47,000 into 4.5. Is the total coming to 379,500? Is the total coming to 379,500? 42,000 into 4 plus 47,000 into 4.5. DA 379,500 into 50%. Fully taxable. Okay. Bonus. October month's basic pay 47,000 plus DA forming part 47,000 into 50% into 50%. Repeating, bonus. Friends, please understand, October month's basic pay plus DA forming part 47,000 into 50% into 50%. How much? Okay. Perquisite value of car 1800 into 8. 1800 into 8. 14,400. Transfer of movable asset, we have done the working note. Transfer of movable asset, we have done the working note. 1,39,000. 1,39,000. We have done the working note. Gratuity, we have done the working note. 3,20,000. Gratuity, we have done the working note. 3,20,000. Commuted pension, we have done the working note. 266,667. Commuted pension, we have done the working note. 266,667. Now I want you to understand what is uncommuted pension. Jan, I will receive 15,000. Feb, I will receive 15,000. For March, I will receive 15,000 into 40% only because 60% stands commuted. Repeating, for uncommuted pension, Jan and Feb I will receive fully. For March, I will get only 40%. Is the class clear? Leave encashment, we have done the working note. Okay. Now in the screen, you will see the answer. Am I clear? And if it is covered under POGA, this 320 is also not taxable. This 320 is also not taxable. That's what is the small difference you will see, that if it is covered under POGA, only 1299 becomes taxable, because 320 should also be reduced. Nothing is taxable as gratuity. Okay. Okay. When we work out the total income, I will work out one more question with gratuity and pension. Please be sure this is more than sufficient. Understand it conceptually, you are hitting it. I'm reading the next question. Priyanka, General Manager of ABC Limited, Mumbai, furnishes the following: salary, value of medical facility in a hospital owned by the employer, not taxable. Not taxable in a hospital owned by employer. Rent-free accommodation, okay. Housing loan, 7 lakhs given on 1/4/25 at interest of 6%. No repayment was made. SBI rate 9.5. So the benefit I am getting is 3.5%. The benefit I am getting is 3.5%. A dining table was provided to Priyanka at her residence. This was purchased for 60,000 and sold to Priyanka on 1/5/25 for 30,000. Let me take some more time. There are two perquisite in this one line. One, usage of asset. Two, transfer of asset. Repeating. In this particular sentence, there are two perquisites. One, usage of asset. A dining table was provided and it was transferred on 1/5. Only 1 month it was used by employer's asset. Used by employee is only 1 month, because on May I am transferring it. On 1st May I am transferring it. So 60,000 into 10% into 1/12. Usage is 60,000 into 10% into 1/12. Usage. For transfer, June 22, June 23, June 24, only 2 years. No fractional period. No fractional period. Only 2 years. Only 2 years. Am I clear? Okay. And 10% SLM. 10% SLM. Personal purchases through credit card provided by the company, fully taxable. A Maruti Suzuki car which was purchased on 16/7/23 was sold on 14/7/25. 20% diminishing balance method. 23, 24, only 1 year. Even though it is 2 days, you cannot, unless the year is over, you cannot provide. Details of other income. Deposit in PPF is for 80C. That too, if you are following the normal tax regime or optional. Compute the GTI if she is excised to opt off shifting out of default, which means normal tax regime. 50,000 will be your standard deduction. Okay. Interest on FD mutual fund, interest on bank FD of a minor married daughter, you will provide 1,500 as a small relief, because you are following the optional tax regime. Friends, I am not wasting time asking you to work out this. Okay. Please understand the working If at all you have any doubt, I will clarify it. Please follow the working. Okay. Salaries consist of basic pay, medical facility provided, rent-free accommodation is directly 10% of basic pay, interest is 3.5%, perquisite value of dining table, it was transferred to the employee on 1/5, and usage is only for the month of April, 500. I will show you the transfer perquisite. I will show you the transfer perquisite. Here is the transfer perquisite. Okay. For SLM for 2 years. Here it is only for 1 year. I'm getting 58,000. I'm getting 58,000. And it is optional tax regime. So only 50,000 standard deduction. When I send you the answer today after class, you can verify this. Okay. It is straightforward and simple, except for examination question 2 attempts back. Okay. Remember, exam questions will have only one twist: transfer of asset or gratuity. It will not have multiple things. Majority out of the 8 adjustments, 6 adjustments will be very simple, straightforward, without any big thinking. 1 or 2 adjustments will only have lot of thinking. But our problem is that 1 or 2 dominates our mind. Actually, it should be the other way around. That 6 will give us confidence, should give us confidence. But actually, the reverse happens. This is a recent examination question only. Oh, I see. Okay. Am I clear? Any doubts? Okay. As I told you, I will ensure to work out salaries again when we are doing total income. Okay. We'll take a very small break, come back to do house property. House property, capital gains, and all are chapters which are now very simple, very straightforward. Understand the nuances. What can be questioned? How it can, we have to be cautious. Those things I am going to tell you. And majority of the time, if I work out MCQs, we will cover everything. Instead of working a lengthy answer, salaries, gross total income, deductions, these are more of lengthy descriptive answers, whereas small chapters will be more on MCQs, where we will understand the nuances, what they are trying to ask us. Okay, after a short break.
Yes, sir.
Let's understand house property, how income is computed under house property, how the taxation is arrived at, or taxable income is arrived at under house property. So we all know it is taxable only for the owner, and the term owner includes deemed owner. Deemed owner is someone where the house is registered in some person's name, but actually some other person is the real owner. transfer of asset to spouse. Transferor is taxable. Okay. Transfer of asset to spouse without adequate consideration. Income is clubbed in the hands of transferor. Wrong. Not in income, club income. I say transferor is only the taxable person. Okay. So, transferor is the owner. Transfer of asset to minor child. Holder of impartial estate, cooperative society, continuous right for 12 years, etc. But the first two alone, remember, transfer of asset to spouse, minor child. Okay, otherwise it is house property is an interesting chapter that notional income becomes taxable, not what you actually earned, but what you should have earned becomes taxable. And how this is computed is by taking 4 factors into consideration. From here on, small nuances, let's understand very clearly. By taking 4 factors: municipal value, fair rental value, standard rent. Municipal value, that which is determined by the local authority, by the state government. Fair rental value, rent of similar property in the same locality. Standard rent determined under the rent control law. And then comes, okay, net actual rent. What is that word? Net actual rent. That is actual rent minus unrealized rent. Rent that is unable to be recovered from the tenant. Okay. Slow. 4 factors determine the income computation: municipal value, fair rental value, standard rent, net actual rent. The actual rent for which the property is let out minus unrealized rent. Friends, I let out the property for 12 months to Harita. Harita vacates the property on January 31st. Feb and March, the property is remaining vacant. This is not unrealized rent. Please understand. Is Harita liable to pay me rent on February and March? No. That cannot be called as unrealized rent. Harita did not pay me the rent of January. That is what is known as unrealized rent. You understand the difference? Unrealized rent, rent due but not realized. Vacancy, rent is not at all due because the property has remained vacant. That is a separate treatment. This is a separate treatment. What I have reduced here is unrealized rent, actual rent minus unrealized rent, rent due but not received. There is a difference. Okay. Now the law says, step 1, I will compare whichever is higher. MV and FRV, whichever is higher. This answer with SR, whichever is lower. And this answer with net A, okay, whichever is higher. This is known as expected rental value. This is known as expected rental value, ERV. Am I clear to you? What are all the things I am taking? MV, FRV, SR, everything for the full period. Actual rent also for the actual let out period. But if at all there is any unrealized rent due but not received, I will reduce it and take up as net actual rent, and I will hit that ERV. Now, my dear friends, ERV, okay, less vacancy allowance. Here only I will reduce. Here only I will reduce vacancy allowance. Number of months of vacancy into rent per month. It will be reduced here to get me gross annual value. This will be reduced to get gross annual value less MT paid by owner, not by tenant. MT should be paid by owner to arrive at net annual value. To arrive at net annual value. Once more from the top, I want you to take down this chart so that you are clear. Okay. MV and FRV, whichever is higher. That answer with SR, whichever is lower. That answer with net actual rent. What is net actual rent? Actual rent minus unrealized rent. If you compare whichever is higher, that will lead you to expected rental value. Please take down. Expected rental value minus vacancy allowance gives me gross annual value less municipal taxes paid by owner. It should be paid and it should be by the owner. Two conditions, my dear friends. It should be paid and it should be paid by the owner. The municipal taxes should be paid. Only if it is paid, it is allowed as deduction. And it should be paid by the owner. Then only the deduction can be claimed.
Sir, unrealized rent is not required. Unrealized rent meaning is not required.
Unrealized rent means rent due but not received. Recovery, I'll come to it later. Okay. So, I want you to understand that municipal taxes paid will be allowed only if it is paid Where it is due not paid, no deduction. Okay. How in the year of deduction, empty paid in advance, empty should be paid by the owner. Where it is paid by the tenant, it will not be allowed. So it should be paid and it should be paid by the owner. Am I clear to you? Am I clear to you? So this is net annual value. This is net annual value. Up to this, am I clear to you? Remember, unrealized rent, if it is given, HP chapter is full of nuances only, not big computation, but small understanding. If unrealized rent is given, reduce it from actual rent. If vacancy is given, first do the steps and then only reduce the vacancy allowance. Then only reduce the vacancy allowance. Is the class clear? Online friends, are you clear? Okay.
Yes,
Yes,
sir.
sir.
No. At this level, I can say to you that this NAV will be nil for a self-occupied property. You need not go to the steps at all. You can direct. Remember, it is not GAV which is nil. Because if GAV is nil, then for municipal taxes, you will claim loss. It is only NAV which is nil for a self-occupied property. The law says for two properties, you can claim self-occupation. The law says for two properties, you can claim self-occupation. Am I clear? Okay. Now, I am teaching you the next nuance. Be very clear in understanding. Here, self-occupied property, am I clear? NAV is nil. Deductions, I will come to it later. First, NAV is nil. Now, I am teaching you something. When should I take proportionate municipal value, fair rental value, standard rent? When should, normally I will take it for the entire 12 months. Normally I will take it for the entire 12 months. When will I take proportionate? If it is divided into units. If it is divided into units, then I will take it proportionately. Then I will take it proportionately. So the house is divided into 3 units, 50% self-occupied, 25% let out, another 25% for some other purpose. Then I will take it proportionately. Is the class clear? Is the class clear? Proportionately I will take it. When construction is completed during the year. My dear friends, my completion of construction is 1st of August. So current year municipal value will only be for 8 months. When will proportionate MV, FRV, SR be taken? When will I take it proportionately? When it is divided into units. The second thing is when my construction itself is completed, the property is not available for 12 months. Then also I will take proportionate MV, FRV, SR. One thing which the class needs to understand loud and clear. Not to be taken in case of partial period let out. Sir, the property is let out only for 8 months. Don't take it for 8 months. Now it is full. Again, I am telling you, Very slowly understand this nuance in house property. Municipal value 5 lakhs. When will I put it into 8 by 12? When construction is completed during the year and it is available only from 1st August, 8 by 12, 1st September, 7 by 12. But the property is ready. I let out only for 8 months. No, sir. Now it is municipal value is for whole year. Where a property is partly let out, partly self-occupied in terms of period, everything will be taken for whole year except actual rent. But proportionate is only in 2 different cases. Right. Not to be proportionated, that's what I mean by not to be proportionately taken is nothing but you should take it for the full year. This nuance you understood? Municipal tax is a small nuance. Unrealized rent reduction is a small nuance. Proportionate is a small nuance. My dear friends, we will all be clear about deduction. For standard deduction is 30% of NAV, obviously for let out property. Obviously for let out property. Standard deduction 30% of NAV. Is that clear? Is that clear? Okay. Interest. Interest on borrowed capital. Interest on borrowed capital. Now, this is divided into two. Interest of financial year 25-26, take it fully. If the property is ready, interest of financial year 25-26, take it fully. Plus 1/5 of pre-construction period interest. Plus 1/5 of, this will be my total interest. This will be my total interest. That is current year interest plus 1/5 of pre-construction period interest. What is pre-construction period? Date of loan to 31/3 preceding year of construction completion. 31/3 preceding the year of completion of construction. Friends, I request you to look into the examples in page number 29. Date of loan 1/4/22. Date of completion of construction 1st November 24. Before that it should be 31st March 24. Date of loan to date of loan to 31/3 preceding the date of completion. Whenever 31/3 comes. date of loan, date of completion. So it will be up to 31st March 24. 31st March 25. The before that when 31/3 is 31/3/24. Date of loan, date of completion 1st October 25 means before that 31st March 25. Pre-construction period means preceding the year in which construction is completed. So up to 31/3 preceding the date of completion. Whatever is the date of completion. அதுக்கு முன்னாடி எப்ப 31/3 that you can put. Don't waste your time in computing here. Logically you have understood in the regular classroom. Examination oriented you understand. They give you date of loan, they give you date of completion of construction. Take date of completion of construction 31/10/25. Before that when did 31/3 come? 31/1/24. Before that when 31/3 came. Okay, so you can put that and complete it. On that take 1/5. So in this current year how much I can claim? Current year full interest plus 1/5 of PCP interest will give me the total interest. Will give me the total interest. Is the class clear? Is the class clear? Now understand. Now all of us understand. Again, I am talking about interest. The total interest, you know how much. Now I am dividing it into let out property, self-occupied property. Fully you can claim. Whatever may be the purpose of loan. Purchase, construction, repair, renewal. Fully you can claim. What you cannot claim, if you mortgage a property and pay interest, that's nothing. Okay, you cannot claim. Purchase, construction, repair, renewal. Fully you can claim. Self-occupied property depends upon whether you are under the optional region or concessional regime. Optional regime, you can claim 2 lakhs for construction or purchase, 30,000 for repairs, okay, or renewal, or the loan is taken before 1499. That is very rare. You can leave that part of it because over close to 20 years, more than 20 years is over. So you can just forget it. But the maximum can only be 2 lakhs. If you are following concessional tax regime, you cannot claim anything. You cannot claim anything. Please take this chart quickly. Are you following? Are you following, online friends? Hope we are all clear.
Yes, sir.
House property is full of very small nuances. Please remember, very small nuances. Shall I? Okay. So this is the structure of house property. So if I look at the format, I will be now able to appreciate it better. Okay, we know how to compute the expected rental value, less vacancy, gross annual value. Here 30% interest on borrowed capital, add 70% of unrealized rent recovered and arrears of rent. This is section 25A. And remember, this is taxable even if the property is sold before that. Normally for house property, the property should be there. But 3 years back, some arrears of rent or unrealized rent is there. Last year, I sold the property. Now I recover. Sir, I am not at all having house, so it is not taxable. It's not right. Okay. 30% standard deduction we can claim. Balance 70% is taxable. Balance 70% is taxable. So unrealized rent and arrears of rent is taxable only in the year of receipt. 70% is taxable. If the question that is not allowed earlier, then we need not. Where the question is silent, it should be assumed. Okay. This is taxable even if the property is sold. This is taxable. Am I clear to you? Okay. Now, some things which you have to, again, some nuances. Sir, I have taken a loan for purchase of the house. Can I claim the interest as deduction? Yes. I take a fresh loan to repay this particular loan. Please understand. I take another loan. Why did I take another loan? To repay my first loan. Because this is available at a lesser interest rate. So I took this loan. Can I claim interest on the second loan? The answer is yes. The law has said where subsequent loan is obtained to repay the original loan. Once more, where subsequent loan is obtained to repay the original loan is taken for purchase, construction, repair, renewal, then the interest on the subsequent loan can also be claimed. The interest on the subsequent loan can also be claimed. Are you clear? Interest on subsequent loan. But any penalty, late payment interest cannot be claimed. Okay, any penalties or late payment interest cannot be claimed. This is one more nuance to understand. Interest on loan, that is subsequent loan. The subsequent loan is taken for repaying the original loan, can be claimed. Are you following? Are you following? Now, can I go to the next most important nuance to understand? All of us in the classroom, be very clear with what we are going to discuss. Where the property is used for own business or profession. Where the property is used for own business or profession. The chapter 8, it goes to PGPP. Now the nuance to understand. The NAV is nil, sir. Because it's own business or profession, the NAV is nil. Friends, in PGBP, I can claim expenditure. Section 30 of the PGBP says any repair, maintenance charges, insurance, direct expenses can be claimed. I am again repeating. In house property, I cannot claim this deduction. House property has only two deductions. 30% of NAV and interest. But whereas if it goes to PGBP chapter, any repair, maintenance, I cannot claim standard deduction. Any repair, maintenance, all direct expenses can be claimed. Section 30 of the PGBP chapter will say that. Okay, what can be claimed against as a, okay. இப்போ interest இருக்கு friends, that can also be claimed. That can also be claimed, but not pre-construction period interest. Small nuance which can be very important. ஏன்னா PGBP சாப்டர்ல அதை வந்து கேபிட்டலைஸ் பண்ணும். Till the asset is put to use, it should be capitalized. Very small nuance, but it will have a larger impact in your working. Please understand, only current year interest can be claimed. Pre-construction period interest is not at all applicable in the case of business or profession chapter. In the case of business or profession chapter at all, it is not applicable. So all expenses, including depreciation, can be claimed against the business income. Against the business income. Okay, you have written. Okay, very important nuance is this with regard to a property used for. So suppose they say I started full house, 50% self-occupied, nil, 25% let out. We know how to proportionate everything, and 25% used for own business or profession. Whatever is the expenses into 25% allowed under section 30 PGBP. Allowed under section 30. There is no standard deduction. There is no pre-construction period interest. This part of it, am I 200% clear to the friends? Okay, you're all understanding. Online friends also, you're understanding, right? Very important nuance. Small nuance. Okay, so this is with regard to house property treatment. Other than this, there is nothing in house property which is going to challenge us. Remember municipal taxes. Remember 15 minutes if you go through the concept book, you will be clear. Okay, municipal taxes, you have to remember interest, okay, etc. I take this opportunity also to end the note of house property with this. Loss. What happens? Loss from house property. What happens? Just listen to this. Let's listen to this. Of course, a set of chapter is separate, but here itself we'll complete it. Anyhow, salaries will not have loss. Now, my dear friends, I again look for whether I am under the optional tax regime or concessional tax regime, old or new tax regime. If I am in the optional tax regime, I have let out, I have self-occupied, both as loss or one as loss another. So there is a this to the extent of 2 lakhs against any income, it can be set off. To the extent of 2 lakhs, it can be set off against only to the extent of 2 lakhs. Balance carry forward and set off only against IHP 8 years. This is under optional tax regime. Old tax regime, you can have loss under let out also, self-occupied also. Correct? You can have on both. Put together what is the loss after adjusting internally whatever is the income and the losses. So the loss comes to 2,50,000. 2 lakh set off against salary, business or profession, capital gains, IFOS, anything. And the balance 50,000 carry forward it. Once you carry forward it, set off only against IHP and maximum is 8 years. Maximum is 8 years. If you are coming under concessional tax regime, self-occupied cannot have a loss because interest is not allowed as deduction. Self-occupied cannot have loss. Let out property, if there is a loss, only against house property. It cannot be set off against other incomes. Under concessional tax regime, cross set off is not allowed. Cross set off is not allowed. Is it clear? Is it clear? Quickly complete this. We will go to the questions. Can I? Can I? Are you all understanding? Are you all understanding? Now, a rough page, a calculator in your hand. I mean, a page and a calculator only. A page and a calculator only in your hands. Shall we? Shall we? Okay. Mr. Vika, I am in page number 27. A calculator in your hand and a rough page for calculation. Mr. Vikas took a loan of 15 lakhs on 1/4/23 for construction of his house. The construction began in June and completed on 36/25. Till what date is pre-construction period? 31st March 25. That is date of loan 1/4/23 to 31/3/25 is pre-construction period, for which whatever is this 2 years interest, 1/5 only I can claim. He has not repaid the loan so far. The amount of interest if he has exercised the option falling under for construction for self-occupation. My dear friends, what is the current year interest? 15 lakhs into 10%, 1,50,000. Quickly. Current year interest 150. PCP interest 3 lakhs, right? For 2 years. PCP interest for 2 years, 3 lakhs. 150 plus 1/5 of 3 lakhs. 150 plus 1/5 of 3 lakhs. How much it comes to? 2,10,000. But maximum you can claim is only 2 lakhs since he is under the old tax regime. Ah, 150 plus 60, yeah. 210.
2 years left. 3 lakh.
Interest of financial year 25-26, 150. PCP is 23-24 and 24-25, 3 lakhs. 1/5 is 60,000. Total 210. Since it is self-occupation, the answer is C, 2 lakhs. The answer is C, 2 lakhs. Friends, Mr. Raghav has 3 houses for self-occupation. What would be the tax treatment? What should he do?
Only
2 houses. Which 2 houses you will claim? Whichever is the higher income, you will claim it as self-occupied. Lower income, we will take it as deemed to be let out. One option to be treated as self-occupied. 2 houses at the option of Raghav would be treated as self-occupied. The other would be deemed to be let out. B is the answer. B is the at the option of Raghav only, not assessing officer. B is the answer. Vidya received 90,000 in May 25 towards recovery of unrealized rent, which was pertaining to financial year 23-24. Legal expenses incurred 20,000. Will I allow it as deduction? Against house property, only 2 deductions, 30%. So here it is. The amount taxable is 63,000. 90,000 into 70%. 90,000 into 70%. Friends, once, twice, thrice we will read it, but we will. These type of questions, small nuances, big answers. Ananya Gupta, a citizen of India, lives with their family in New York since the year 2000. Okay, even our friend Ananya Anand should be in New York. Not at all, I am seeing here in the classes. Okay. She visited India from 27th March 25 to 28th September 25. The small nuances, now calculate பண்ணும்போது 1st April. Only from 1st April we should calculate. We should not go back to 27th to take care of her ailing mother. In the last 4 years, she has been visiting for 100 days every year to be with her mother. She owns an apartment in New York, which is used as a residence. The expected rental value, the value of dollar, municipal taxes. She took ownership and possession of her house in New Delhi for self-occupation. MV, FRV, paid municipal taxes, and now comes the main part of the answer. Because it is self-occupied house, we need not be worried, NAV nil. She had taken a loan of 16 lakhs at 10% from IDBI on 7th April for constructing, and the construction got over on 7/4/21 to 31/3/24. 31/3, 20th March 25. That before that 31/3 would have come in. Okay, is our pre-construction. No amount has been paid towards principal repayment. The house is vacant for the rest of the year. She had a house property in Mumbai which was sold off, for which she received arrears of rent. This amount has not been charged to tax earlier. She had no other income. Ananya Gupta want to exercise the option of shifting out of default tax regime. Based on the fact, we will answer the following question. What is the RS of Ananya Gupta? Quickly, we'll write down. Okay. 1st April to what date she is here? 28th September. How many days? Is she an Indian citizen visiting India? So, second basic condition, is she an income in India exceeds 15 lakhs? No, because the Delhi house is self-occupied. You cannot have any income. Only the 3 lakhs is her income. So, listen friends, she is an Indian citizen visiting India. Her Indian income is not exceeding 15 lakhs. So, only first basic condition not fulfilled. So, she should be a non-resident. She should be a non-resident. Are you clear? Any doubts? Ananya Gupta can claim benefit of nil annual value in respect of, answer it. Answer it. Answer it. Ananya Anand, answer it. Which option? Which option? அதெல்லாம் பார்த்துட்டு notebook. Delhi, why New York house is not, you cannot claim self-occupation? Very good answer. That is the answer. New York house we should never worry because she is a non-resident. That is never taxable in India. Only Delhi house. Because நம்ம examination tensionல 4 answer பண்ணக்கூடாது. Both Delhi and New York கிடையாது. New York house has nothing to do with their things. Okay, I have written here. You have to be careful. Since she is a non-resident, income of New York house does not accrue or rise in India. Hence, it need not be checked. For Delhi house alone, she can claim self-occupation. She can claim self-occupation. Correcta? Correcta? Ilakya Sri, you are understanding?
Yes, sir.
Yeah. What is the income chargeable under IHP of Ananya Gupta? Let us quickly. 3 lakhs into 70%. Arrears of rent received 3 lakhs into 70%. How much? 2 lakh 10,000. What is the self-occupation interest she can claim? Current year interest 160 yakannu. PCP also maximum put together 40,000. PCP is also there for 2 years, Leah. 2 years or 1 year? Photominga. PCP is for 21 to 24, 3 years. 160 into 3. But whatever it is, self-occupation maximum is 2 lakhs. Self-occupation maximum is 2 lakhs. So the answer should be 10,000. ரொம்ப நேரம் பண்ணவே கூடாது எக்ஸாம்லயும். 3 lakh into 70%, 2 lakh 10,000. Self-occupation maximum is 2 lakhs. Only if you are very whether it will come closer to 190, 180, அப்பதான் calculate பண்ணோம். 3 years past period இருக்கு. 3 years past period இருக்கு. So you should not waste your time. Are you following? Online friends are there, no? Online friends, are you following?
Yes, sir.
Thank you.
Yes, sir.
Okay. Assuming that for the purpose of this question alone, Ananya has let out the Newark property for 6 months. Why does it change the answer? Okay, right? For a sum of where such rent was received in bank account in Newark and then remitted to India, what would be the income? It will still be 10,000. It will not change. It will not change. Can I? For the assessment year, Mr. Sonu submits the following: building in Chennai, Kochi. MV, FRV comes third, SR, rent received. Municipal taxes paid by tenant for building at Chennai and paid by Sonu for building at Kochi. Sorry, friends. This alone, change it to 4,000. In my answer, I have changed. In question typing, I made a mistake. Repairs paid by tenant Mr. Ramu for Chennai building and Sonu for Cochin. Land revenue, insurance premium, interest on loan borrowed for payment of not allowed. When will interest be allowed? Purchase, construction, repair, renewal. Nature of occupation, let out for residence, let out for business. So what? Date of completion. Mr. Sonu is constructing one more building in Mumbai. Mr. Raju, a film director, took on rent building under construction, not house property. Only if the construction is completed, it is house property. For 5,000 per month, this will be IFOS. Only if the building is completed, you can. Mr. Sonu is a real estate developer and letting out is not his business. Based on the fact above, quickly we'll do. Okay. In the notebook, Chennai, Kochi. In the notebook, Chennai, Kochi. I will first find out the NAV, MV versus FRV, 35, 31. So 35 is higher. That compared with SR, 36, whichever is lower, 35. That compared with rent, whichever is, so 38. 38, GIAV. First I am putting GAV. 38. On the other side, 80, 82. 82 is higher. 82, 70. 70 is lower. 70 and 68. So 38 and 70 are GAVs. 38 and 70 are GAVs. Are you clear? Are you clear? Are you clear? 38 and 70 are GAVs. Less empty. In the first case, it is paid by the tenant. In the second case, only 4,000. 4,000. Now you will get NAV. Give 30% standard deduction. Give 30% standard deduction. Interest don't allow. How much you come to?
26,600, 46,200.
26,600, 46,200. So total comes to 72,800. Another 60,000 is there. That is IFOS. Okay. Using this, we will answer. Which of the building income is chargeable to IHP? Both Chennai and Kochi. Which of the following expenditures is allowable as deduction while computing IHP? Municipal taxes paid by Sonu and Mr. Ramu? No. Municipal taxes, land revenue? No. Only municipal taxes paid by Sonu. Under which head of income the amount received by Mr. Raju would be chargeable? IHP, PGBP, IFOS, IHP or IFOS at the option of Sonu. What is the amount of IHP? How much you said? 72,800. Is the class clear?
So the third question, why are the options?
Not at the option, sorry.
From our
Oh, okay. IFOS. Yeah. Shall we? Miss Prerna is having a residential house property in Nagpur, 1/3 self-occupied, 2/3 let out for commercial purpose at a monthly rent of 12,000. FRV for the let out portion, MV and standard rent for the whole property. MT 10% and are paid on 30th July. She took a loan of 4,50,000 for construction of this from a scheduled bank. She repaid the entire loan along with interest on 36. The interest rate was 12%. The construction was completed on 30th June 24. So 1/4/23 to 31/3/24. 1 year alone pre-construction period. 1 year alone pre-construction period. She earns other income of 2 lakhs. She wishes to pay tax under default tax regime. Quickly we'll work out. Okay. Let out portion. Because self-occupied, you cannot claim anything. Let out portion. Okay. MV 240 into 2/3. 2/3, huh? 240 into 2/3. How much? 160. Okay. FRV 30,000 into 12, 360. 30,000 per month. SR 3 lakhs into 2/3, 2 lakhs. AR 12,000 into 12, 1,44,000. Tell me what is the GAV? 2 lakhs, correct? MV or FRV, whichever is higher, that compared with SR, whichever is less, and that compared with AR, whichever is higher. So 2 lakhs will be the GAV, correct, friends? Minus MT of let out portion. Minus MT of let out portion. How much? 16. Okay. So 1,84,000. 1,84,000. 30% standard deduction. After interest also.
just
30% of standard deduction. அதுக்கப்புறம் interest போடுறேன். கொஞ்சம் கவனிங்க. She repaid the loan on 36. So current year interest is only for 3 months. Current year interest is only for 3 months. So what is the loan amount? 45 lakhs into 10% into 3/12 into 2/3. 45 lakhs is for the whole property. 45 lakhs into 10%. Aging 45 lakhs current year interest. 45 lakhs into 10% into 3 by 12 because it is repaid on 30th June into 2 by 3 for the let out portion. $75,000. PCP will be 45 lakhs into 10% into 2 by 3 into 1 by 5. PCP interest will be 45 lakhs into 10%, 4 lakh 50,000, 1 year only pre-construction period, into 2 by 3 for the let out portion, into 1 by 5. Repeating, 45 lakhs into 10%, 450 is for the whole house. 1/5 is allowed, 90,000 into 2 by 3, 60,000. So total interest is 1.35. Okay, having this information with you. Okay, now answer the questions one by one. The NAV of the house property will be 1,84,000. The NAV will be 1 lakh. Just now we computed 182 lakhs minus 16,000. Deduction in respect of interest on loan 135 plus 135 dana 135, sorry. Compute a total income. She has 184 minus the standard deduction 135. Our other income is 2 lakhs. This loss holda. This cannot be set off against because she is falling under. Very good question. She is falling under concessional tax regime. Please write down somewhere loss. How much is the loss? 184 minus 30%. I've written these things. See, I have written here. IHP results in a loss under concessional tax regime. This cannot be set off against any other income. The whole of IFOS becomes taxable. That is 2 lakhs. Very small, interesting nuance. Ivlada house property. If you read this, this is more than sufficient. We'll complete IHP, take the break. Aditya owns a residential house property whose MV, FRV, SR. The house has 2 units. Unit 1 is utilized for his business or profession. Unit 2 is let out for residential purposes at a monthly rent of 8,500. MT 8% of MV which are paid by the owner. He made the following: light and water repairs, interest on loan taken for repair. Mr. Aditya takes a loan of 5 lakhs in July 20 for the construction. Construction was completed on 30th June. So 22, 31, 3, 23. He paid interest 12%. No repayment of loan was made. Income from his profession without deduction of anything, including depreciation. Determine GTI ignoring the provision of 115 BAC. Computation of IHP. Please write down. Computation of IHP. Hyphen let out. Computation of IHP hyphen let out. Okay. Okay. Shall I? Okay. MV in the inner column 160 into 75%. MV in the inner column 160 into 75%. How much? 1 lakh? 1,20,000. FRV in the inner column 170 into 75%. SR 190 into 75%. Actual rent 8,500 into 12. Actual rent 8,500 into 12. Now tell me what is the GAV? 1,27,500. One lakh 27,500. Okay, 127,500 less MV 8 MT municipal taxes 8%, 1,60,000 into 8% into 75%. You will now get NAV. Now you will get NAV. Standard deduction 30%. Standard deduction 30%. Interest. Friends, slow. Okay, so are you clear? Slow, follow me. Interest on repairs 36,000 into 75% in the inner column. 36,000 into 75% in the inner column. Okay. Current year interest 5 lakh into 12% into 75%. Current year interest, that is for the financial year 25-26 interest, 5 lakh into 12% into 75%. How much are you getting? 45,000. Now, all of us listen. PCP is for 1st July 2020 to 31st March 23. 1st July 2020, 9 months of 2021, 2 years of 21-22 and 22. So 2 years, 9 months. All of us understanding? 2 years and 9 months. Friends, 5 lakh into 12% into 2 years will come to somewhere 120 plus 1 to 240. 5 lakh into 12% is 60. Sorry, 60 plus 60, 120. Another 60 into 9 by 12. The total PCP divided by 5 into 75%. The total PCP divided by 5 into 75%. Check whether you are getting this. Is it clear? Is this clear to all of us? Any doubts? So this interest is very important computation. Remember. Now computation of business income. This you get a loss of 14 to 20, right? Computation of business income. Receipt 8 lakhs. Less allowable expenses. 25% of municipal tax. 25% of municipal tax. 160 into 8% into 25%. 3,200. 25% of light water charges, repairs, interest on repairs. 25% of all these three. 2,000 plus 145 plus 36 into 20. Remember, these are allowed. Light charges, repairs are allowed in business. Okay. Okay. 25% of current year interest. 25% of current year interest. 60,000 into 25%, 15,000. Depreciation 8,000. Is this the answer? Okay. And the assessee is following optional tax regime. So the house property loss can be adjusted against business income. Okay. One more question to wind up the chapter of house property. Mr. Yokesh constructed a house with 3 independent units. Unit 1, residential purpose at a monthly rent. Rent of January could not be collected and a notice to vacate was given to the tenant. No other property is occupied. Unit 1 remains vacant for Jan, Feb and March, which is not put to any use. Unit 2 is for the purpose of business. Unit 3 is for the purpose of its resident. MV, FRV, SR, MT paid by Yokesh, repairs, interest on borrowed capital, ground rent, fire insurance, business income. Determine if he pays tax under concessional tax regime. So self-occupation மறந்துடுங்க. Only let out and business we need to calculate. Only if it is default optional tax regime, we need to find out the self-occupied also. Okay, quickly, I mean, I'm not detailed working out. Quickly, MV is 144, 50% floor area. 144. FRV is 149. SR is 130. 139. Okay, 139. Actual rent is 20,000 into 12 minus 1. So 20,000 into 11. Net actual rent for reduce the unrealized rent alone. Don't reduce vacancy here. Don't reduce vacancy here. So tell me what is the expected rental value. My dear friends, MV, FRV, SR, AR. Okay, 220 minus vacancy. After that only we should reduce the vacancy. Check my house property working. Empty paid is also 50%. Is it clear? Are you getting the same answer? 70,500. Are you getting online friends? Are you getting this answer? Okay.
Sir.
Yeah. Business straightforward and simple. For business, every expenses is allowed. There is no standard deduction and all. Okay. So that will take us to the total income also. Okay. We will take the break, meet again, and now we'll go to capital gain. I'll teach you what are all the nuances, and then we'll do it. Meet you after the break. Moving on to capital gains. Moving on to capital gains. From the examination perspective, I will separately deal with slum sales. That we will deal with it separately. Otherwise, what needs to be done? I will first talk about this full value of consideration. I will first talk about this full value of consideration. And I will deal with it in three different manners. First, immovable property. Apply section 50C. Apply section 50C. For immovable property, land or building or both, apply section 50C. Look for actual consideration. 110% of actual consideration, stamp value. If this is more than this, then stamp value. Otherwise, actual consideration. Otherwise, actual consideration. Is it clear? Is it clear? These are popular. These are very popular. Okay. So, immovable property, this is how we need to compute. The next popular is shares. If these are unlisted shares, look for actual consideration or fair market value, whichever is higher. They will give, I have 10% of shares. I sold it for 3 lakhs. The overall net worth of the company is 40 lakhs, which means 10% comes to 4 lakhs. That is the fair market value. They will very clearly give, if at all it is a unlisted shares, the fair market value. Okay, if at all it is unlisted shares, the fair market value. I'm not dealing with slump sales. I'm keeping it separately. Others, take the actual. Take the actual. Full value of, this is it. What is meant by actual? It can be insurance compensation. It can be original compensation. If an asset is converted into stock in trade, fair market, on that date if I have sold, fair market value on the date of conversion. If a partner introduces capital, whatever is recorded, whatever is the sale value, that is known as actual. Friends, this is the important thing to remember. Immovable property is the important thing to remember. I want you to understand, though I have written from the top every case wise. Okay, that is for you to just go around when you are not clear. Otherwise, come to page 40. Come to page 40. There I have summarized everything. There I have summarized what you need to know with regard to full value of consideration. And remember, in the case of immovable property, actual consideration, however, if the stamp value exceeds 110%, then the stamp value. And also for 50CA, the unlisted shares. Others I will come slowly. Okay, these two completely remember. These two completely remember. Same way, I can say what is cost of acquisition. Same way, I can give a very simple table of cost of acquisition from the examination perspective. Purchased before 1/4/2001. Purchased before 1/4/2001. I purchased these shares, this asset before 1/4/2001. FMV as on 1/4/2001. If stamp value is less than FMV, then stamp value. Of course, if the actual is higher, actual always. Okay. Otherwise, you have to take this. If the stamp value is less than FMV, take the stamp value. Otherwise, take FMV. If the actual is higher, then take the actual. Gift or inheritance. Okay. Cost of previous owner. Gift or in all other cases, actual cost. Except there is a 112A which I will speak. In all other cases, it is the actual cost. My dear friends, the next table in page number 41 summarizes. Asset normally in 142,001. Okay. However, FMV should not exceed stamp value. Asset acquired, gift or inheritance, like that. So this is the table. Full value of consideration is depending upon immovable property, unlisted shares, others. Cost of acquisition is depending on purchased before 1/4/2001, acquired as a gift, got it as a gift or inheritance, and in any other case. And in any other case, find out the actual cost. Is the class clear? Is the class clear? Okay. Now, let us go and understand something more unique. We all know capital gain chapter will come if there is a capital asset and it has been transferred. Okay. Okay. It should be a capital asset. It should have been transferred. What is not a capital asset? Stock in trade, rural agricultural land, movable personal asset. Immovable is always capital asset. Movable personal asset other than jewelry, work of art, architecture, painting. So if you are selling car, no. Televisions, no. Refrigerators, no. Nothing. Okay. All these things are not capital asset. Leave the gold bonds or special bearer bonds. What is not a transfer? Gift or inheritance. If amalgamation, if I am a shareholder, also not taxable. Demerger, also not taxable. That's sufficient. That is sufficient from the examination perspective. Okay. So gift or inheritance, amalgamation, demerger, okay, partition of HUF and liquidation of a company. These are not considered as transfer. That is more than sufficient. And assets are divided into short term and long term. Why are we dividing? For three reasons. One, rates of taxes are different. Set of provision is different. STCL can be set off either against STCG or LTCG, whereas LTCL can be set off only against LTCG. Okay. Set of provisions are different. And very few cases, the mode of computation, indexation benefit can be there for a long-term capital asset, never for a short-term capital asset. So assets are classified into long-term and short-term. Listed shares, securities, units of business trust up to 12 months. And in any other case, up to 24 months, it is short-term. Anything other than that is a long-term. Am I clear to you? Am I clear to you? What is this? Indexation. To adjust the inflationary impact. To adjust the inflationary impact prevailing in the economy. The government releases something known as CII, Cost of Inflationary Index, CII, every year. how to index. Numerator will be CII of the year of transfer. Denominator will be CII of the year of acquisition or 100. Why 100? If it is purchased before 1/4/2001, it will automatically be 100. Okay, that is indexation. Cost of acquisition into numerator CII of the year of transfer divided by CII of the year of acquisition or 100. Similarly, for any capital expenditure incurred after acquisition, we call it as improvement. Improvement before 1/4/2001 needs to be ignored because everything is covered in the fair market value. So, friends, okay, indexation is a benefit which is given by the government on some things. Now, indexation is removed. For your year, while computing capital gains, you need not do indexation. While computing capital gain, never do indexation except 2 cases. Indexation is still valid only in 2 circumstances. If the sale is before 23/7/2024, remember. Sir, why will a sale before 24/25 be taxable in 25/26? Normally, it would have been already over. This is where one small nuance can come in exam. Sale has happened before 23rd July 24, but taxation happens only now. Repeating. Sale has already been completed before 23rd July 24, but the taxing of the same is only going to happen in the current year, 25/26. What cases this is possible? Insurance compensation. That is extinguishment of an asset. If an asset is destroyed, my dear friends, if an asset is destroyed, okay, taxable in the year of receipt of compensation. So, the destroyal might have taken place before 23rd July 24, but it is taxable now. Similarly, friends, compulsory acquisition, conversion of asset into stock in trade. In these three circumstances, there is all possibility that it has taken before, that is the sale has happened before 23rd July 24, and it is taxable in the financial year 25/26, and it is taxable in the financial year 25. That is why indexation can come. This is part A of my discussion, why indexation is still valid. Part 2 is the benefit available for individuals or HUF at the time of computing tax. For the benefit available for individuals and HUF at the time of computing tax, the asset sold should be immovable property. The asset sold should be immovable. This is a benefit available for computing tax, and the asset sold should be immovable property. Then only this benefit. The asset sold should be immovable property. Then only this benefit. Are you following? Are you following? The asset sold should be immovable property. Then only I will give this benefit. What is that benefit? Okay. Tax will be 12.5% without index or 20% with index, whichever is lesser. This will be only at the time of computing tax, not while computing income. While computing income, I will directly minus that only. Otherwise, this will be at the time of computing tax. This alone, please write down.
Sir, can you explain the second part again?
Yes, correct. If assessee is an individual, I am selling a house property and I am selling it in the financial year 25-26. Normally, indexation is not there. Let us take that I sold it for 1 crore. I had purchased it for 30 lakhs. 70 lakhs is my capital gain. No change in that. No change in that. 70 lakhs is my capital gain as it is. While computing tax, income tax law gives me a benefit. Am I an individual? Yes. Is the asset sold an immovable property? Yes. Then you do one thing. 30 lakhs I index பண்றேன். I am getting indexed value, indexed cost of acquisition, for example, as 65 lakhs, which means if I index, my capital gain is 35 lakhs. If I don't index, my capital gain is 70 lakhs. Repeating, indexed cost of acquisition comes to 65, normal cost of acquisition 30. So my capital gain, if I index, comes to 35 lakhs, without index comes to 70 lakhs. Assessee can pay 12.5% of 70 lakhs or 20% of 35 lakhs, whichever is lesser. Whichever is lesser. This is only at the time of payment of tax, not at the time of computing capital gain. Capital gain already computed 70 lakhs. At the time of paying tax, while computing the tax alone, I have the benefit of, again, if the asset sold is immovable property, no other asset has this benefit, 12.5% without index or 20% with index, the capital gains with index, whichever is less. Am I clear? So this is full value of consideration, just a small update of full value of consideration indexation when it works. So let me start from the top. We know what is a capital asset, what is not a capital asset. Transactions not considered as transfer. So if it is a capital asset, if it is transfer, then my mode of computation, full value of consideration minus cost of transfer expenses minus cost of acquisition, which will normally include any expenses at the time of acquisition, and some cases like gift 1/4/2001, minus cost of improvement after 1/4/2001 or on or after 1/4/2001. Before that, depending upon the asset, I will get either short-term capital gain or long-term capital gain. So that is our part A of our discussion. Now, asset purchased before 1/4/2001, I have told you. Gift or inheritance, I have told you. Extinguishment, destroyal of the asset. Compensation received. Remember, it is taxable only in the year in which compensation is received. Okay. Transfer is the year of destroyal, but capital gain will be in the year of compensation, where destroyal is before 23rd July 24. Indexation might be available, even though this year you are taxing. compulsory acquisition, whatever is the government compensation, same points. If at all court increases the compensation, that additional compensation, only one expenses is allowed, that is legal expenses is allowed and will be taxable. Asset converted into stock in trade, on that date if I have sold what it is, and it will be taxable. JDA, don't worry much about JDA. Monetary plus fair market value, otherwise it is not an important thing. And important thing is shares. Important thing is shares first. Shares alone, never miss it. Immovable property or shares, the repeated question. Rarely jewelry, rarely other things, but always immovable property and shares. Understand here. First நம்ம பார்க்க வேண்டியது, is it listed shares or unlisted shares? Listed shares has a separate treatment. Unlisted shares has a separate treatment. Why? Because of this thing called security transaction tax. Because of this thing called security transaction tax. So what is that? Friends, in the case of listed shares, we are at the time of purchase and sale paying something known as security transaction tax. அது pay பண்றதுனால, because we are paying that, income tax should be lesser. That is government's idea. Because they are paying one other tax, income tax should be lesser. In the case of short-term capital gain, normally short-term capital gains are taxable at slab rate. So assessee might be paying 30%. He will be in 30% slab. Considering he will be in 30%, now the tax rate, if you are paid the STT, is only 20%. Section 111A. Section 111A, only 20% if STT is paid. Are you following? Section 111A. Section 112A, if it is LTCG on which STT is paid. Sir, adun 12.5, idun 12.5 dana. Ma'am. But one benefit which the government gives is the first 1,25,000 is not taxable. The rates are same as like other LTCG. But the first 1 lakh, so that is the benefit the government is giving because you are paying one other tax, which is known as STT. Now, only one aspect which you have to remember in the case of listed shares is, if it is purchased before 31/1/2018. Listed shares date of purchase. It is actual cost of FMV, whichever is higher. Okay, like asset purchase before 1/4/2001. Here also actual cost or FMV as on 31/1/18, whichever. If it is purchased on or after 1st Feb 2018, only take the actual cost, no problem. Other than that, what you need to remember in shares, there are few things. Bonus shares, the nuances. Bonus shares before 1/4/2001, take the FMB as on to 1/4/2001. After that, nil. After that, nil. Rights, whatever is the price paid to the company plus any sum paid to get the right. Okay. Okay, to get the right. Okay. And ESOP on the date of exercising option. This table is very important for your examination. This table is shares itself is important. Don't miss anything in shares. There are a lot of nuances. What is that? What if I don't sell the shares but sell the right? I am eligible to subscribe for 300 shares. I sold that. I have not sold shares. I have only showed an eligibility to subscribe. Whatever consideration received is taxable as STCG. Whatever consideration I receive is taxable as STCG, and for the buyer, whatever they have paid will form part of cost of acquisition. Please remember, transfer of right to subscribe is also taxable. The whole of the consideration received is taxable as short-term capital gain. Is taxable as short-term capital gain. Please read page number 37 and 38, only the shares part. I'll just join. Are you clear? Are you clear? Okay. So please be sure about shares. Never miss shares. Okay. Especially rights issue, bonus issue, ESOP, everything ESOP on the date of exercising, because up to that you will have taxed in salaries. So that becomes cost of acquisition, FMV on the date of ESOP. Bonus shares and rights. Remember, renunciation of rights is taxable also. And this 112A transaction, okay, is taxable. Can I proceed? Depreciable asset, we will see it later. As I told you, finally, I will finish it with the 50B. Finally, I'll finish it with 50B. 50C, we have completed. Okay. And then comes the most important exemptions. So this is our ICOA, CIA of the year of transfer divided by acquisition. Indexation is applicable if the asset is transferred. What is indexed cost of improvement and improvement before 1/4/2001 should be ignored. And the special provision on indexation at the time of computing tax. Okay, assessee should be individual or HOF, and he has transferred immovable property. Assessee has the option to pay 12.5% and 20%, whichever. Remember, this is only at the time of computing tax and not at the time of computing capital gain. For computing capital gain, it's over. That is, இன்கம்லாம் முதல்ல இன்கம் போடுவோம், அதுக்கப்புறம் டாக்ஸ் போடுவோம். While computing income, you should ignore this. You should do directly. While computing tax only, this is applicable. Am I clear to you? There are 4 main exemptions: 54, 54B, 54EC, 54F. 4 main exemptions. 54B is slightly dormant, not a very popular question area. The other 3 are. In the I think I have added. one thing is these two are added in 54 EC by a notification. Apart from NHAI and REC, HUDCO and renewable energy development. Again, HUDCO is again infrastructure, renewable energy. These two are added, but we'll go one by one. I'll again show you this. For taking that. For section 54, if you buy a house, sell a house. If you sell a house, buy a house, you get this exemption. What is sold is also house property. What is invested is also a house property. You will get this exemption. Don't worry about 2 years, 3 years. Adalla fulfill பண்ணுவாங்க. Okay. If you don't, before due date of filing returns, you will deposit it in capital gains account scheme and avail it before due date. Now, gross LTCG or amount invested or rupees 10 crores, whichever is less. Repeating, gross LTCG or amount invested or rupees 10 crores, whichever is less. What is amount invested? If the gross LTCG does not exceed 2 crores, then you can even buy 2 properties. Where it exceeds 2 crores, you are restricting yourself to only one property. Only one property. Okay, right? And the new property, don't sell it for 3 years. And the new property, don't sell it for 3 years. If you do it, whatever was previously not taxable, exempt, will become taxable now. Am I clear to you? This is next is agricultural land to agricultural land, same condition. This is also available for STCG. Not a very dynamic provision from the examination perspective. 54 is dynamic. 54 EC. Please take down the two new bonds. Am I clear? Okay. Now, in 54 EC, a nuance to remember is whenever they give you a date of sale, always 54 EC na immediate 6 months kulla irkan parunga. First nuance to remember. Second, most popular. Final, many times the students have not noticed that. 54 EC is only for jewelry transfer. I transferred jewelry and invested in within 6 months in 54 EC bonds. Can I get the exemption? No. Asset transferred should be a long-term capital asset and it should be immovable property, land and building. It should be land and building. It cannot be for any other asset. It cannot be for any other asset. Very important point. Very important point. And up to 50 lakhs, you can get it. Any of these three, up to 50 lakhs, you can get it. But remember, watch two things before giving 54 EC. Is the asset transferred immovable property and is it invested within 6 months? Is it invested within 6 months? 54F has one more nuance, a lot of internal nuance. First, the method of computing exemption. What needs to be invested is net consideration and not full value of consideration. I mean, not capital gains. What needs to be invested is net consideration. If the whole of the net consideration is invested, whole of the capital gain is exempt. Where only part of the net consideration is invested, proportionate exemption. Proportionate exemption. So first thing to see. And second thing to see in 54F is sell any asset other than house property. Remember, house property to house property, I will get 54 itself. Why will I need 54F? Why will I need 54F? Sell any asset other than house property and purchase house property, you will get this. You will get this. And remember, you should not be a high net worth person. That means you should not own more than one house. Own one, get for the second. If you are already owning two houses, no more 54F for you. No more 54F for you. Okay. Assessee should not own more than one house property on the date of claiming exemption and 3 years after that. Otherwise, the same as like anything. In all the cases, if you deposit in CGAS within the due date of filing returns, that will also be taken as investment. And in this case also, the maximum is restricted to 10 crores, not for high net worth clients. Okay. Remember 54, 54B, 54EC, and 54F. Anyhow, reading all the four, you read it. 54B, slightly lesser. But everything has small nuances. Please catch the nuances that will help you to understand better. And these are all the tax rate. STCG on which STT is paid, LTCG, and LTCG on which STT is paid. Okay. So from the top, sir, yes, sir. Yes, Krishna.
Sir, 54F வந்து assessee should not own more than one house property. So is that only in India or outside India also?
In India.
Yes.
Am I clear? Okay, right. Now, let us understand once more the chapter, except 50B, which I'll take it up separately. Full value of consideration, 50C ஞாபகம் வச்சுங்க. Very important, 50C. Unlisted sharesக்கு FMV கொடுத்தாங்கன்னா check. In all other cases, insurance compensation, compulsory acquisition, compensation paid by government, fair market value on the date of sale, whatever comes, you take it. Only the year of taxation differs, but all these things are the same. Cost of acquisition, is it before 1/4/2001? Take fair market value. If the stamp value is less than fair market value, take stamp value. Otherwise, fair market value. If the actual cost is higher, that alone will prevail. Gift or inheritance, cost of the previous owner. In all other cases, actual cost plus, if at all, any expenses at the time of purchase. Shares alone as a separate case we need to study. Shares alone, primary issue, secondary issue, bonus issue, rights issue, all these things. Okay. and then focus on exemptions. When will indexation come? Three special cases. If the transfer has happened up before 23rd July 24, எப்ப சார் அது நடக்கும்? Insurance compensation, compulsory acquisition, asset converted into stock entry. In all these cases, the transfer might have happened already. Now only you are taxing, so it can come. Otherwise, at the time of computing tax, if the assessee is an individual or HUF, and if the asset transferred is a immovable property, then 12.5% or 20%, whichever is less. Whichever is less. Is the class understanding? Is the class understanding? Okay. And the rates of taxation. 2 minutes for you to read through. Then we'll go to question. Then I will do slump sales and answer the slump sale questions. Shall we? Shall we? Calculators on hand. Calculators on hand and rough notes. Yeah, one more thing I failed to say. Sorry. One more thing which I want to tell you, very rare, but I want you to remember this in cost of acquisition. One more thing, very rare, but I found this in our MCQs, so I want you to remember. Advance money forfeited. This is split into two. Before 1/4/14, that is up to 31/3/2014, reduce it in cost of acquisition. Whatever is the cost of acquisition, from that reduce it. After the, okay, 1/4/14, okay, in IFOS, it is taxable. So this part of it, don't worry, we'll see it in. If the advance money forfeited date is on or before 31/3/2014, reduce it from the cost of acquisition. Reduce it from the cost of acquisition. It will be here. Advance money received and forfeited before 31/4/2014. Such advance money will be adjusted with COE. Friends, going to page number 34, going to page number 34 of our practical material. Mr. Ram, an Indian resident, purchased a house property before 1/4/2001. The fair market value and the stamp value is 33.5 and 32.4. Please take 32.4. On 5/2/2012, before 1/4/2014, Ram entered into an agreement for sale of his property and received 3.9 lakhs as advance. However, the balance was not paid, so Ram forfeited. So 32.4 minus 3.9, 32.4 minus 3.9, 28.5. What would be the indexed cost of acquisition of Ram if he sells the property in 25-26? 28,50,000 into 376 by 100. Here is my computation. Since stamp value is lesser than FME, greater than actual cost, the same should be considered. Advance money should be reduced. Hence, net cost will be 2850 indexed into 376 by 100.
So 31, 3, 12,
14. வாங்கிக்கிறது 2012 இருக்கலாம். ஆனா provision 31/3/2014. For an assessee who is a salaried employee who invests in equity share, what is the benefit available in respect of security transaction tax paid by him on sale and acquisition of 100 listed shares which has been held for 14 months long term? What is the benefit? What is the normal benefit? The first 1,25,000 is not taxable. Okay. C, capital gain without deducting SA is taxable at the concessional rate of on such capital gain exceeding 1,25,000. Friends, some calculation involved. Mr. Arun transferred the following long-term capital asset. Residential 8,6, so 2 crores. Jewelry 3,2, so 1 crore. Mr. Arun purchased a new residential house property for 1 crore on 28/2 and deposited 3 crores in CGAS. On 1/5, Mr. Arun has withdrawn 3 crores from capital gains deposit scheme and acquired a house worth 2.5 crores. What would be the capital gain if expenses in connection with transfer of jewelry is 20 lakhs? My dear friends, sorry, இது வந்து 3 minus 20 lakhs, so 2.8 minus 2 crores, 0.80 lakhs. Okay, in the 2 crore, I can wholly claim it as exempt. Correct?
house property.
House property to house property. That is 1 crore and another 3 crore is deposited in. So 2 crores I can claim it as exempt. Okay. Remaining எவ்வளவு இருக்கு? 80 lakhs capital gains இருக்கு. Investment is another 2 crores. Correct? இப்போ 54F. 54F comes into play. 54F. Okay. What is the gross LTCG? 80 lakhs into amount invested 2 crores. ஏன்னா out of the 4 crore invested 2 crores நான் ஏற்கனவே claim பண்ணிட்டேன். Divided by இங்க பாத்தீங்கன்னா 2.8. 2.8. How much it comes to? How much it comes to? Oh, neither answer. Sorry, 98 lakhs. Right? Sorry. Total capital gains exceed 2 crores. Total capital gains exceed 2 crores. So you cannot claim for jewelry. I'm sorry. You cannot claim for jewelry. So 98 lakhs of jewelry is fully taxable. 98 lakhs of jewelry is fully taxable. I missed that point. Sorry. 2.8 crores on the tip of capital gain. Where the capital gains exceeds only one property you can claim. So in the 3 crores on the 2 crores claim பண்ணிருப்பீங்க. The jewelry becomes fully taxable. Jewelry becomes fully taxable. That comes to 80 lakhs தானே? இல்ல 98 lakhs. 80 lakhs.
2 lakhs.
இல்லையே 3 crores.
Expense வந்து 2 lakhs.
2 lakhs. Okay. அப்போ 2.98 minus 2, 98 lakhs. Sorry, I missed that point. Please write down this point. Please write down that point. Capital gains on jewelry becomes fully taxable. As exemption under section 54F cannot be claimed. As exemption under section 54F cannot be claimed. It cannot, okay, it cannot be claimed as the gross gain exceeds 2 crores. I'll fill it this answer also. I'll fill it. Friends, slow and steady. Mr. Krishan purchased a house property in 92. Fair market value and stamp value. So stamp value, I will take it as 2,20,000. On 31st August, he entered into an agreement to sell this house, got an advance of 60,000, and the advance was forfeited. So 220 minus 60 becomes 180. You agree with me? It is forfeited before 31/3/2014. So it becomes 180. In May, Kishan constructed the first floor for 235. In the current year, he sold it for 15 lakhs. This is part A of the question. Mr. Kishan also holds 1,000 shares in an unlisted company. The company offered him rights of 160 per share in the ratio of 2 shares for every 5 shares. So, எவ்வளோ shares I am eligible to subscribe? 400. That is 1,000 into 2 by 5, 400. Mr. Kishan retained 50% and renounced the remaining in the favor of Mr. Kush for 30 per share. Later, all the shares were sold by Kishan for 300 and Mr. Kush for 280. Indexation will never be applicable now. From the following information, choose the appropriate answer. Compute the amount of capital gains in the hands of Mr. Kishan in respect of sale of house property, not tax, capital gain. Friends, 15 lakhs minus 1,80,000 minus 2,35,000. 15 lakhs sale value, 180 and cost of improvement 235. 15 lakhs minus 1,80,000 minus 2,35,000. எவ்வளோ?
10,80,000. Sir, அது அந்த 1,80,000 போட்டீங்க, அது வந்து 1,60,000.
அந்த கூட ஆப்ஷன் இல்லையா சார்?
இல்ல இல்ல எனக்கு புரியல.
சார் அது 160 சார். 220 minus 60 160 ஆயிடும்.
160 ஓகே.
1 lakh அப்படி பண்ணா ஆன்சர் இப்போ
15 lakhs
minus 1,60,000 minus
2,35,000.
11 lakh
11,05,000 ஆப்ஷன் இல்லை. எனக்கும் நானும் பார்த்தேன் ஆப்ஷன் இல்லை. ஓல்டு கொஸ்டின்ஸ் சமயம் இன்ஸ்டியூட்ல அப்படி காப்பி பண்ணிடுறாங்க. அப்பெல்லாம் இண்டெக்ஸேஷன் இருந்தது, அதனால காப்பி பண்ணியிருப்பாங்க. டோன்ட் வரி, இதுக்கு மேல அந்த அந்த மிஸ்டேக் வரக்கூடாது. I also understood this. This is 11,05,000. I also agree with you. 11,05,000. ஏன்னா மிச்சதுக்குள்ள ஆன்சர் வந்தது. Compute the capital gain in the hands of Mr. Kush. Okay, see friends. Kush has sold the shares for 280. He had purchased the share for 160 and the rights for 30. Please understand, Mr. Kush has paid 160 to the company and also paid 30 rupees for Kishan for getting the right. So 190 will be his cost of acquisition. 280 minus 180, 280 minus 190 into how many shares? 200 shares, right? Out of 400, 50% goes to Kush. $18,000. Correct? Compute the capital gain in the hands of Mr. Kishan in respect the transfer of shares. Friends, ரொம்ப கேர்ஃபுல்லா கம்ப்யூட் பண்ணோம். கிஷன் என்னெல்லாம் பண்ணிருக்கார்? In the 1,000 shares which he has purchased for 75,000, he has sold 300 per share. அது long term. That is long term. Then he has sold 200 rights. That's not shares, which is short term. Other than that, he has also sold 200 shares. Other than that, he has also sold 200 shares, which is also short term. Mr. Kishan, first 1,000 shares he has sold now. That is held for more than 24 months, long term. Another 200 rights he subscribed, which means he purchased. That is also 160 he has purchased, he has sold it for 300. Another 200 rights he sold. So what is the correct answer? That is 2,25,000 of LTCG and 34,000 of STCG.
Plus 6,000. 6,000.
Pakka clear? Any doubts? D is the answer. Are you following? Okay. Mr. Pankaj, a resident Indian, purchased a residential property before 1/4/2001 FMV and stamp value on 5/2/2016 after 1/4/2014. Please ignore that. Mr. Pankaj entered into an agreement and received as advance, however, did not pay the balance. Mr. Pankaj forfeited the advance. On 10/5/2025, Pankaj sold the house property to Mr. Rohan for 1.5 crores when the stamp value was 2 crores. Friends, 1.5 sale value. 110% comes to 1.65. Stamp value comes to 2 crores. So 2 crores will be taken. So 2 crores will be taken. Are you clear? Okay. Further, he purchased 2 residential house property, 57 lakhs each. Okay. Mr. Pankaj has no other income, the due date of filing returns. On 31/1/27, next year, Pankaj decided to sell one of the property to his brother, Mr. Gaurav, for 58 lakh and received 25,000 in cash at the time of signing. Sale deed was registered and the balance amount was paid. The stamp duty values were 61 and 64 respectively. Based on the question's case law scenario, choose the appropriate answer. What shall be the cost of acquisition of residential house of Kanpur for computing capital gains? How much is that? In Kanpur, 25 lakhs, correct? Okay, there is no other deduction. So 25 lakhs is the cost of acquisition. Is the class clear? 25 lakhs. The amount of capital gains, okay, 2 crores minus 25 lakhs, 1.75. 1.75. So far clear? The amount of capital gains taxable in the hands of Mr. Pankaj on sale of house property at Mumbai. That is, he has sold it to his brother. All of us should listen for some time. Though I will teach this provision in IFOS more clearly because I can consolidate and teach it. Sale value to brother, how much is that? 110% of sale value. Stamp value on date of registration. Why I am saying registration is advance is received in unapproved modes. If advance is received in approved, I will teach that in IFOS more clearly. If advance is received in approved modes, date of booking. Otherwise, if advance is not received or received in unapproved modes, date of registration. 64. Correct? Okay. So what will I take? 64.
Stamp duty value.
Very good. What is the cost of acquisition? 57. I get 7. I get 7. But I will again add this 57. Why? He has sold the house property within 3 years. He has transferred the house property within 3 years. So 64 lakhs is the capital gains taxable. 64 lakhs is the capital gains taxable. Repeating the answer. Oh, sorry, I have written that. Solution 64 inga maatha mutten. The 55 exemption should be withdrawn. So the answer will this institute la 7 nu kodutanga. No, 64 is the answer.
Second question. And how sale பண்ணனால அந்த exemption subtract பண்ணி.
ஆமாம். Yeah. Now 1.75 capital gains amount. I should have put 1.04. Okay, that is exempt. First exemption provide பண்ணிட்டு withdraw பண்ணணும். You're right. 61. இது வந்து 64. Institute material 7 lakhs answer கொடுத்திருக்காங்க. Okay. Not possible. It should be say because it is ஒரு assumption what transfer to brother. Is it transfer? Gift though not a transfer. Here he has actually transferred, got consideration. So 64 lakhs should be the answer. Okay. So this is not 1 point. This is 1.06. Oh no, so 61. The amount taxable in the hands of his brother. The amount taxable in the hands of his brother. Anyhow, I'll teach it in IFOS. As of now, take it as nil because gift received from or inadequate consideration received from relative will not be taxable. I will teach you that provision and answer this question again. I will teach you that provision and answer this question again. What will be the tax credit available with Pankaj in respect of sale of property at Kanpur? Again, I will teach you these provisions again, but I'm trying to recollect to you. Section 194IA states 1% of stamp value or actual consideration, whichever is higher. So 2 crores into 1%, 2 lakhs is the tax credit. TDS. What will be the tax credit? Not TDS for Pankaj. Section 194IA. When I am doing the TDS provision, I will do it again. But 194 IA. Is Mr. Pankaj supposed to file his return? Yes. Yes, since his income exceeds basic exemption limit. Before giving any exemption, okay, I mean, actually, this is the answer. Okay. I'm not answering the May 26 now. I will do slum sales as a separate arena. Okay, I will do slum sales as a separate arena. Don't worry. In the descriptive question, I am going to page number 41, question number 2. In the descriptive question, page number 41, question number 2. Mr. Arjun, a resident individual, sells unlisted shares for 10 lakhs. These shares were purchased for 2 lakhs, brokerage paid. Mr. Arjun deposited 5 lakhs in CGAS. On April 30th, he withdraws 450 and purchases residential house. Compute the capital gain. So asset transferred is shares, asset invested is house property, 54F will come. Let's start. Write down descriptive. Full value of consideration 5 lakhs, 10 lakhs. Full value of consideration 10 lakhs. Less cost of acquisition, cost of transfer 2000. If net consideration 9,98,000. Net consideration 9,98,000. Less cost of acquisition 2 lakhs. Gross LTCG 7,98,000. Exemption under section 54F. Exemption under section 54F. எவ்வளோ இருக்கு gross LTCG? Gross LTCG எவ்வளோ? 798 into 5 divided by 998. 798 divided by 5 lakhs into the, okay, into, sorry. 798 into 5 lakhs divided by 998. Am I clear? Okay. Tax treatment of the unutilized amount. Write down. The unutilized amount is taxable at the end of year 3. The maximum 3 years you have to wait. The unutilized amount is taxable at the end of year 3. So we are in assessment year 26-27. That will be taxable in 29-30. Determine the capital gain, next question, or loss in the case of listed equity shares, STT paid, and units of equity fund in the assume these are the only transaction under 112A. Mr. Shogun purchased 300 shares, friends, before 131-118. Before 31-118 at a cost of 400. He sold all these shares for 1,200. The prices is, you should take the highest. You should take the highest on 31-118. Okay. So 3-1. Full value of consideration. Full value of consideration. 300 into 1,200. 300 into 1,200. Less COA, since it is purchased before 31-118, since it is purchased before 31-118, we should consider the highest price prevailing on 31-118. So 300 into 700. Gross LTCG, how much are you hitting at? It cannot be so low. 1,50,000. First 125 not taxable, balance taxable at 12.5%. First 125 not taxable, balance taxable at 12.5%. Oh, the tax itself has to be computed. Please compute the tax also. Do it for the second case. Do for the second case also. I can show you the answer. Now let's move on to slump sales. And in the classroom, I have made it clear the word S is a silent word. Okay. So, what is this? Sale of a division, unit, without assigning values for individual assets and liabilities. Sale of a unit or division without assigning values for individual assets and liabilities is known as slump sales. So I sell all my assets and the liabilities to another company for a total consideration. So the full value of consideration will be fair market value of outgoing assets. They will give you clearly this. Or actual consideration, whichever is higher. We call it as FMV1 or FMV2, whichever is higher. FMV1 consists of, I have some land which I am selling it to the other company. I don't know its individual value because I have totally sold it for some total value. Now, if I see the land, I purchased it for 15 lakhs. Now its present value 40 lakhs. Some machinery is there which is 30 lakhs. Some other assets are. So I compute the total, the fair market value of the asset and find out what is the outgoing assets fair market value or what is the actual consideration, that is the incoming, how much, whichever is higher. This will be very clearly specified in the question. Okay. Less cost of transfer, we all know. Net worth. Here I want you to understand few nuances. Net worth. What is net worth? Net worth is nothing but asset minus liabilities of that unit or undertaking. Net worth is nothing but asset minus liabilities of that unit or undertaking. Now, whenever I am speaking about assets, I take the book value, that is the income tax value of the asset. Why I am saying this book value is ignore revaluation. If suppose there is a land which is 1000 lakhs or 10 lakhs. Are you understanding? Okay. There is a land. There is a revaluation of 300 for this land. Now the net value is only, the book value is only 700. You have revalued it. You have revalued it. So always ignore revaluation. Always ignore revaluation. And one other most important thing to remember is, for all depreciable assets, compute WDV as on 1/4/25. Suppose they have not provided depreciation. You should provide depreciation and find out its value. We should, because, or this is the small nuance you have to understand in slump sales. Two things, please be careful. Not even full value of consideration that they are giving in all questions, or at least the fair market value of outgoing assets will be clearly known to you. But where exactly is the problem, or what exactly is the nuance? While computing net worth, please remember to ignore revaluation. Also, for depreciable asset, compute after providing depreciation. If they have not provided, after providing depreciation, please compute the values. Friends, I am there in the page number 39 of our concept book. Transfer of unit without assigning values. Full value of consideration will be outgoing assets or incoming assets, whichever is less. Okay. How to value immovable property, stamp value, investment, value as per depreciated value. If they have not provided depreciation, please ensure to provide. Please ensure to provide. Am I clear to you? That is very important in all these things. I'm going to page number 40 because this question has the depreciation impact to a larger extent. Page number 40, question number 1. Mr. Shivam is the proprietor of 2 units. He transferred unit 2 for a total consideration of 18 lakhs. 78,000 is the cost of transfer. What is unit 2? Land 750. On the liability side, I see a revaluation reserve. I will come for that. Furniture, debtors, patent. On the liability side, revaluation. Bank loan 70% for unit 1. So 30% for unit 2. Creditors, unit 2 given. Unsecured creditors, unit 2 given. Other information. Land was purchased for 5 lakhs and revalued. So when I go for the net worth, I will only take 5 lakhs. Okay, revaluation. No individual asset. Patent was acquired on 1/12/23 on which no depreciation has been provided. Furniture is acquired for 5 lakhs on 1/12/24. No depreciation has been provided. Fair market value of outgoing asset 1810. Compute capital gain. Read through. I am first doing computation of value of patent and furniture as on 1/4/25. Computation of value of patent and furniture as on 1/4/25. Particulars, patent computer. Particulars, patent computer. Purchase price on 1/12/23. Purchase price of 1/12/23 for patent 7,25,000. In the patent column 7,25,000. In the patent column 7,25,000. Less depreciation at 12.5%. Used for less than 180 days. Less depreciation at 12.5%. எவ்வளோ 90625. Value as on 1/4/24. Value as on 1/4/24. Okay. Purchase on 1/12/24. Furniture column la 5 lakhs. Purchase on 1/12/24. In the furniture column 5 lakhs. Less depreciation 25% for patent and 5% for furniture. 25% for patent and 5% for furniture. Is it coming to these amounts? Is it clear? Is it coming to these amounts? Are you getting this? Computation of net worth. Computation of net worth. Land, ignoring revaluation. Five lakhs. Furniture, you know the value, you have now computed. You know the value, you have computed that. Furniture, you have just computed it. 275. 475. Debtors, 350. Patent, you know the value. Less 30% of bank loan. 30% of bank loan. 850 minus 30 into 30%. 20% of creditors. 30% of unsecured loans. Is it 1335,781? Computation of capital gains. Computation of capital gains. Full value of consideration under that FMV1 comes to 1810.
18 lakhs outgoing
Outgoing assets. No, they have given no. At the end of it, they have given
10,000.
18 lakh 10,000. 18 lakh 10,000. 41 இருக்கு பாரு. 18 lakh 10,000. FMV2 consideration received 18 lakhs. Whichever is higher to the outer column, 1810 minus cost of transfer 78,000 minus net worth. Am I clear? Shall I move on? Shall I move on? Okay. This is about capital gains. Capital gains. I am again repeating examination perspective. 50 CL stronger இருக்கணும். Immovable property. Cost of acquisition before 1/4/2001. Shares. Most probable question. Slump sales. And all the 4 exemptions, read it. It will not take more than 1 hour. Do these questions. This is more than sufficient. More than sufficient. Again, I am telling you, when we do total income, we will touch upon these things again. Depreciable asset, when I do PGBP, I will do it. Am I clear to you? Okay. Moving on to income from other sources. Income from other sources. Is dividend taxable? Yes. Only one expense is allowed. Interest on loan taken for investment, restricted to 20% of dividend. Actual interest or 20%. Friends, very sure short discussions include dividend. Okay. Actual interest or 20% of dividend, whichever is less. I want to make one thing clear to you. I invested in shares of X, Y, Z, but I got loan only for shares of X. Should I compare that dividend and 20%? No. Actual interest or 20% of the total dividend. Of the total dividend, not that particular, all dividends put together, whichever is less. For dividend, the TDS is 10%. I'm telling it here because 1, to recollect. 2, if they are given net, how to gross up, divided by 90 into 100. Friends, don't worry about 222E, but just be sure about buyback of shares. Whatever you receive is deemed dividend. Whatever you receive. But one thing now I'm not bothered about this also is next year the provision changes. Next year it goes to capital gains. From IFOS, they have removed it to capital gains. In a changed provision, they might not question you. So, but just all type of winnings are taxable. No expenses or losses or deductions will be allowed. All type of winnings, including online games winnings. All type of winnings are taxable. Okay. If it is any article in kind, fair market value is taxable. All types of interest except tax-free interest are taxable. 2 expenses are allowed. One, for a post office, 3,500 or 7,000. Another is collection charges or interest, same like dividend. In dividend, collection charges are not allowed. Here, collection charges are additionally allowed. Okay. These 3 are very mandatory to know. Dividend, winnings, interest. All other things are just browse through questions. After this, gift only is important. After this, gift only is important. These 3 are mandatory. What other things to remember? Quickly I'm browsing. Family pension. The deduction is 1/3 of the pension or 15,000 if it is optional tax regime, 25,000 if it is concessional tax regime. Interest on delay in payment of compensation, taxable only in the year of receipt. Interest on delay in payment of compensation, taxable only in the year of receipt. Please remember, they might say interest pertaining to 22-23, 23-24, 24-25, and this year's interest. No. Everything is taxable only in this year. 50% is given as standard deduction. 50% is given as standard deduction. Family pension, I have told you. Don't worry about temporary letting out. Director sitting fees outside India, ground rent, subletting, all these things are taxable. Quick read through of 47 and 48. May I? So remember, dividend, interest, winnings, family pension, that deduction, etc. Very rarely interest on other compensation. Now, friends, gift. What gift are not taxable? On the occasion of wedding of the assessee, the most important nuance is assessee's wedding. If it is brother's wedding, sister's wedding, son's wedding, daughter's wedding, it is taxable. Only on the occasion of marriage of assessee, it is not taxable. Okay. Second thing to remember, relatives. Third thing to remember, public charitable trust. And fourth, by will. These are not taxable. Okay. Relative. What is that relative? Assessee, spouse. Parents, parents. Brothers and sisters, brothers and sisters. Brothers and sisters, son, grandson. Okay. So it's a small thing. Cousins are taxable. Cousins are taxable. Wife's parents, brother, sister, taxable. Only your own parents, brothers and sisters are not taxable. Spouse, parents, brothers and sisters are taxable. Spouse, brothers and sisters, not taxable. Okay, this is the smallest relative explanation. They are not going deeply and checking whether you know this, etc., but generally. Otherwise, it is. Now, when I take gift, monetary, if it exceeds 50,000, wholly taxable. Immovable, if it exceeds 50,000, if the stamp value exceeds 50,000, wholly taxable. Movable, if the fair market value exceeds 50,000. In movable, remember this. In movable and in monetary, it is aggregate. Here it is individual. Both in movable and monetary, it is not per gift, it is aggregate. Whereas immovable, it is individual. Now coming back to movable. Whatever is taxable in your capital gain will only be taxable here. Jewelry, work of art, painting, shares, those are only taxable. Whatever is not taxable there, I get a gift of i10 car. Neither in capital gains it is taxable, nor in IFOS it is taxable. I get a gift of a television which is worth 1 lakh. Neither in capital gain somebody is selling, nor I am receiving as a gift is taxable. Only those which are mentioned specified assets are taxable. Is the class clear? In both movable and immovable, there is a concept called inadequate consideration, which becomes taxable. If that also exceeds 50,000, that becomes taxable. Here is the questionable area in immovable property. What is that? Here also this 110% of stamp value. Sir, I purchased a land for 10 lakhs. Actually, the stamp value is 10,60,000. Now, nothing is taxable in my hands. Why? 110% comes to 11 lakhs. Since the stamp value has not exceeded 110%, it is not taxable. It is not taxable. Are you understanding this? Since the stamp value has not exceeded 110%, it is not taxable. Small nuance. First, I check the 110%. Has it exceeded that 110%? First, we need to check on this. Then only the other factors will come into play. Is the class understanding? I'll give you one more nuance. Land value 1 lakh. Stamp value 1,50,000. 110% comes to 1,10,000. Now also not taxable because the difference has not exceeded 50,000. Rendum பார்க்கணும். 110% it should have exceeded, and the inadequate consideration should be more than 50,000. Then only the whole of the inadequate consideration becomes taxable. Are you understanding this? This is the small nuance you have to understand. That is, check for 110%. Even in capital gains, same. Now, for capital gains, IFOS, business or profession, I am going to give you one thing. Stamp value on what date? Stamp value on what date? Advance received by approved modes. Then stamp value on the date of booking agreement. Okay. Advance not received or received otherwise. What is otherwise? Other than, what is otherwise? Cash, bearer check, cross the check. These are otherwise. Okay, stamp value on the date of registration. Once more, I am going to talk about all these things. Once more, I am going to talk about all these things because the most important question comes from gift, where the aggregate value exceeds 50,000 whole. Stamp value, if that exceeds 50,000, inadequate consideration, difference between stamp value and consideration paid, that exceeds 50,000. However, up to 110%, I need to check. Here also, fair market value, aggregate gain exceeds 50,000. Same, okay. Gift on the occasion of wedding, relatives, will, etc. relatives. Now the common point for all the three sections. Okay. Stamp value on which date? Where advance is paid by approved modes, date of booking. No advance or other things, date of registration. Am I clear? Am I clear? Okay. Okay. Again, calculators. Superb questions that you cannot henceforth make mistakes on gift. I'm in page number 43, question number 1. Kashyap has acquired a building from his friend for 15 lakhs. The stamp duty of the building is 1620. Income chargeable in the hands of Kashyap. Friends, let us put 15 lakhs is the purchase price. 110% of 15 lakhs, 16 lakh 50. Stamp value 16 lakh 20. Stamp value has not exceeded 110. The difference might be higher. So gift will be inadequate, consideration will be nil. Inadequate, nothing is taxable in the hands of Kashyap. Once more repeating the answer. Once more repeating the answer for clarity. Remember, stamp value has not exceeded 110. ரெண்டுமே பார்க்கணும். ஸ்டாம்ப் வேல்யூவும் எக்ஸீட் ஆயிருக்கணும். டிஃபரன்ஸும் 50,000க்கு மேல இருக்கணும். ஒன்னு இருந்தா போறாது. Both should be fulfilled for getting into it. Mr. Devam has received a 75,000 from his friend on the occasion of his. The entire 75,000 is chargeable to tax. Entire 75,000 is chargeable to tax. Mr. Vikas received a gold ring 60,000 on the occasion of his daughter's wedding from his friend Vishnu. Taxable? Yena value has exceeded. Mr. Vishnu also gifted the gold chain to Kavya, daughter of Vikas, worth 80,000 on the same occasion. Avalukku taxable? No, because it is her wedding. What would be the taxable value of gift? Yes, the gift is taxable both. No. Sia. Value of gold ring is taxable in the hands of Vikas, but value of gold chain is not taxable in the hands of Kavya. Because it is wedding of her, it is not taxable. Mr. X, aged 61 years, earned a dividend of 12 lakhs. Interest on loan taken for the purpose of investment 3 lakhs. How much is maximum allowed? 2 lakh 40. 20% is only allowed. 9 lakh 60,000 is taxable. Slower pola case law scenario. Mr. Satak, a share broker, sold to his friend Anay, who is an automobile dealer, for 120 lakhs. Sold building when the stamp duty was 150 lakhs. So date of registration, the stamp value is 150 lakhs. The agreement was entered when the stamp value was 140. Satak has received a down payment of 15 lakhs by crossed check. So unapproved modes. So date of registration the valid. Mr. Satak purchased this building for 95 lakhs. Further, Mr. Satak also sold an agricultural land situated in a village having a population of just 5,800 for 60 lakhs, which he acquired for 45 lakh. Stamp duty 65. Based on the facts of the above scenario, choose the most appropriate answer. What is the amount of tax to be deducted by Mr. Anay and Mr. Vivek? Mr. Vivek need not deduct. I will again tell you 194 IA என்னன்னு. Rural agriculture land, why not? Tax கிடையாது. Only for building 150 into 1%. ஏதாவது stamp value or actual consideration, whichever is higher, into 150 into 1%. So second is the answer. 1,50,000 by Mr. Anay nil. இது 194 IA. அது நான் I will again teach you while teaching TDS. What amount of capital gains are chargeable to tax in the hands of Mr. Satak in respect of building transfer? So let us do that. Okay, 150 போடுங்க, 150 notebookலையும் போடுங்க, 150 minus 95. 150 minus 95 தான purchase price, 95. So 55 lakhs without indexation. 55 lakhs without indexation. Index ஓட போடலாம். 95 into 376. 95 into 376 by 280. 95 into 376. அதில் கொடுக்கல வேல்யூ 376 last year ஓட வேல்யூ. 2526 ஓட வேல்யூ 376. 95 into 376 by 280. எவ்வளவு வருது? 150 minus 127. 150 is the sale value. 22.4. எந்த ஆன்சர் கரெக்ட்னு சொல்லுங்களேன். Which is the right answer? 1. இல்ல ஃபர்ஸ்ட் ஆப்ஷன் தான்.
Option 1, sir.
நான் தப்பா டைப் அடிச்சிட்டேன். 95. If this gets cut, you please let me know. If screen sharing gets cut. Okay, so you are understanding this. You are understanding this first. Okay. Question number 3. If Mr. Satak has other income exceeding basic exemption limit, the tax payable excluding surcharge and HEC on transfer of building. எதுன்னு சொல்லுங்க. இது with indexation அப்படின்னா 20%, without indexation 12.5%. Which is lesser? Without HEC and all. How much? 448, 571. with indexation. 20% with
indexation is less.
Yeah. With indexation, 20%. What is the amount of income chargeable in the hands of Mr. Anai in respect of building? The பாருங்களேன், அனைக்கு வந்து inadequate consideration. Anai, okay, Mr. Satak sold the building to Anai, his friend, so not a relative. Inadequate consideration. Ipo, who is a dealer now for rupees 120 when the stamp duty is 150. 120 into 110% comes to 132 da. So exceed 30 lakhs. Difference between stamp value and this 30 lakhs will become taxable. The answer, inadequate consideration, difference between stamp value will be taxable as the stamp value exceeds 110%. Are you clear? இதுதான் inadequate considerationல ரொம்ப ஸ்ட்ராங்கா இருக்கணும். Remember, this is an excellent question. Again, giftல you will become stronger in these questions also. Mr. Akshaya Biani celebrated his 26th birthday and arranged a grand party. On the occasion, his friends, relatives, and distant relatives attended the party. The ceremony was grand. The feast was also spectacular. All the arrangements and decorations are wonderful. At the end, he received the following gift. Mother gifting gold chain, not taxable. Okay. The cost of the previous owner is 37,822. Father getting gold bracelet, not taxable. Wife 4 gold rings, each carrying 35,500, not taxable. Not taxable as gift. Okay. Okay. இங்கேயே நான் ஹிண்ட் பண்றேன். இந்த மதர் கொடுத்த கோல்டு செயினை நான் செல் பண்ணா in whose hands it is taxable? Father கொடுத்ததை செல் பண்ணா, wife கொடுத்ததை செல் பண்ணா taxable in the hands of asset transferred by spouse without adequate consideration. Income is taxable in the hands of transferor. அங்கதான் இந்த question உடைய nuance. Asset transferred by mother, taxable in my hands. Father in my hands. Brother in my hands. Asset transferred by spouse. Subsequently, I sell it, or whatever income I earn it will be taxable only in the hands of spouse. நம்ம வந்து Sriram gave some gift to his wife. Kalpesh gave some gift to his wife. இந்த மாதிரிலாம் question classroomல போட்டு, where we said it will be taxable in the hands of transferor. Clubbing, that is more of clubbing. So fair market value was 37,400. Sister presented a painting, not taxable. Sister presented a painting, not taxable. Father's brother, gold chain, not taxable. Closest cousin, ஆனா present பண்ணது not taxable, because it is not a specified asset. Movable என்னெல்லாம் taxable? Jewelry, art, work of art, architecture, painting, shares. So friends and other distance, cash 1,51,000 tax. Mr. Akshaya desires to set up new manufacturing unit with his friends in partnership. For making investment, he sold the following jewelry which he received: mother's gift, father's gift, father's brother's gift. His wife gave him 1 lakh as gift that he could not invest the sufficient money in the unit. He invested 6 lakhs. and his friend invested 4 lakhs. On 15th, his wife again gave him 1 lakh as a gift to invest the money. This apart 50,000 from his individual saving and his closest friend. Since the firm is a manufacturing unit at the initial stage, the firm required sufficient funds. Akshay sold his wife's gifted gold ring for 40,250 and deployed. Based on the above, choose the correct answer. Let's go slow and answer it. What is the amount of capital gains in the hands of Mr. Akshay? இப்போ மதர் கொடுத்தது, ஃபாதர் கொடுத்தது, ஃபாதர்ஸ் பிரதர் கொடுத்தது, இதெல்லாம் செல் பண்ணது ஏ ஹேண்ட்ஸ்ல தான். எல்லாமே ஷார்ட் டேர்ம் தான். We will write down. Sale value 42,150, 60,180, 2,600. Sale value 42,150, 60,180, 2,600. Purchase value, the cost of the previous owner, அது 37,822, 56,075 and 18,200. ஆனா wife சேல் பண்ணது இங்க not taxable in his hands, remember. So எனக்கு எவ்வளவு ஷார்ட் டேர்ம் கேபிட்டல் கெயின் வருதுன்னு சொல்ல முடியுமா?
10833.
Clear? What is the gift amount not considered? Very important. Not considered under 56(2). What is the gift amount not considered? Add பண்ணலாமா ஒவ்வொன்னா? Okay. Mother 37,822. Father 56,075. Okay. Wife கரெக்டா போடுங்க. 37,429 into 4. Each other. 37,429 into 4. Sister 45,000. Father's brother 18,200. Wife வந்து ரெண்டு cash gift கொடுத்திருக்காங்க பாருங்க. 1 lakh ஒரு வாட்டி, another 1 lakh, 2 lakhs. So how much? இல்லையா ஆன்சர் இல்லையா?
3,6,813.
இதுதான் கொஞ்சம் பார்க்க முடியுமா? அங்க into 4 போடணும், ஞாபகம் வச்சுங்க. அந்த I10 காரையும் ஆட் பண்ணிக்கணும். 4,10,000 அதுவும் not taxable. சாரி, அது மறந்துட்டேன். That I10 car should be added also. You want me to repeat? I will repeat. First வந்து 37,429 into 4 போடுங்களேன். Plus 37,822 plus 56,075 plus 45,000 plus 18,200 plus 4,10,000 plus 2 lakhs. Correct? 916813. What is the gift amount taxable? 1,51,000. Is any amount taxable in the hands of Akshaya's wife in respect of sale of jewelry? If yes, what is the taxable amount? Okay, yes, it is taxable in her hands only. The parangla 40 to 50 each. 40 to 50 into 4 minus purchase price. 35,500 into 4. 19,000. Okay. So in the question miss பண்ணாம வீட்ல ஒரு வாட்டி before exams also, because this gives you a lot of idea about gift and spouse, etc. And very you need not even do this question. From the following, calculate the taxable amount under proper head. He is paying tax under default tax regime. Dividend 45,000 net அப்படின்னா 50,000. Advance money forfeited 1 lakh. Cash gift from non-relative on the occasion of marriage of his son taxable 51,000. Received 99,000 family pension, 1/3 or 25,000, whichever is less. Okay. Okay. We'll see set off in the next class. Next class my is on 14th. Okay, where my concentration is PGBP. Time available, we'll do the set off. Okay, where I'm going to fully allow PGBP, fully make you understand PGBP from the top, and the nuances, what sort of questions in the most probable things, MSME adjustments எப்படி பண்ணோம், statutory payments, TDS, those things we will see. Okay, thank you. Meet you on 14th. Okay, all the best, friends. All the best, online friends. The answers will be sent to you.
Thank you, sir.